Okay, we'll get started. Good morning, everyone. This is Clark Andrews. I'm on the sales and trading desk with Echelon Capital Markets. I'm joined by my colleague, Mike Mueller from our equity research department here in Calgary. We're gonna walk you through 7 of our favorite stories in the renewable energy, ESG, and energy transitions space, and we're gonna highlight a few ideas and names that are in the lithium, the hydrogen, the renewable natural gas, and the hydrogen space today. We want to share just kind of our general views of what we think a company that is trying to break into a developing and emerging sector, such as the mentioned lithium, RNG, hydrogen, and general ESG sectors. So starting off today, we're gonna hand it over to Chris Dornbos from E3 Metals, which is an Alberta-based lithium producer. So I'll have Mike Mueller introduce you, Chris, and have at it from there. Thanks.
Thanks, Clark. Like Clark said, we have Chris Dornbos, President and CEO of E3 here presenting this morning. As Clark mentioned, this is a junior lithium developer. They're also a direct lithium extraction technology company, about 150 million market cap. It's got its flagship 100% owned PEA level lithium brine project that's located in Alberta. With that, I'll hand it over to you, Chris, to have a more fulsome overview of E3.
Excellent. Thank you, guys. And thanks for having me on the platform today to talk about ESG. I think this is a great home for E3's project in terms of a slate of other discussions that you guys are having today. And I'll take you through why that is as we go through this. But there's probably a lot of people on the call who've heard the story, know E3, but for the sake of those who don't, I think I have 25 to 30 minutes, so I'll go through a general overview as well. I do have some slides focusing on ESG and how E3 fits into that as well. So just an introduction to who we are. Alberta-based lithium development company that brings both a massive resource and a new dealy technology to the lithium space. The benefit that E3 has about being in Alberta, and for those Albertans in the room, you'll understand this fundamentally, is that we're repurposing a historic oil asset that was discovered by ExxonMobil in 1947. This is the Leduc Aquifer. It is a massive aquifer with a huge and prolific production capabilities. It has been producing oil since the 40s. Exxon moved out of it in and around the 90s after the oil was mostly produced off. There's small companies still trying to make a little bit of revenue, but the majority of the oil has been produced. And therefore, we are just transitioning this incredible asset from an oil producing life to a lithium producing life and giving it another 35 to 40 years of production out of it. The real benefit, though, is other than the fact that we know this aquifer and we know how to produce from this aquifer, is that it operates like oil and gas here in an oil and gas heavy industry province such as Alberta. And that means things like social license, which is an incredibly important part of ESG, is very well established for the operations that we plan to put into place here in the province. And this picture is a great example of what that looks like. So this is our project location just north of Calgary, about 40 minutes northeast. These are farmers' fields. This is the primary surface industry in this area is farming or ranching. This area in particular, farming. And what you see here is farmers' houses and the farmers' fields with grid roads intermixed with oil and gas infrastructure. And this scene is common throughout the entire south half of the province, where you see oil and gas infrastructure in the middle of farmers' fields. And there's a very well-developed system of working with the landowners to have facilities on their land. They get revenue. It's a small amount, but it's enough for them to get through bad farm years where you have bad weather and you don't have the harvest. This revenue that they get from the companies that have facilities on their site keeps them going through those years. So it's very symbiotic in that sense. If you look at the infrastructure, there's grid roads every mile. Out here, there's towns dotted through this whole area. There's power. There's the main trunk line for natural gas that goes down into the United States, runs through this property, as well as one of Alberta's major power lines runs through this area. So great access to infrastructure. The project is located 20 kilometers southeast of Red Deer. Red Deer is the oil and gas service hub for Alberta, where all the service companies have their service departments. So you have drill rigs, you have pipe companies, you have welders, you have all of the things that you need to build a project 20 kilometers away down paved highways from the project site. So this really sets us apart from pretty much any lithium company out there in the world because of where we're located in Alberta. So there's obviously some forward-looking statements that I'll be making. This is here, it's also on our website, please have a read. E3 set out a goal of growing this company to be a leader in responsibly sourced lithium. And, you know, the goal of growing this company to be a lithium producer is founded on two fundamentals. One is the proprietary technology. So we have developed a technology leading the space now in direct lithium extraction, enabling us to get lithium from these brines in Alberta, but most likely everywhere in the world as well. The other piece of this is that we have our own resource base. So we've got 7 million tons of resources in the Leduc Aquifer, and I'll take you through that in a later slide. Very few projects in this world produce battery-grade lithium products. E3 Metals produces, out the back of our plant, we plan to produce a battery-grade product. So the process that we're developing is engineered for purity, meaning that we are going to be developing a product that will be sold directly to the battery manufacturers, which is uncommon today. It's not how it's done because the projects that are in operations today were never designed for the battery market. They're designed for the old market for lithium, which is greases, ceramics, and that sort of thing. With batteries, purity is the most important quality of your product. So you need to have that process developed and well refined. The DLE technology that we developed enables that, and I'll take you to that as well. So looking at the Alberta operations is a fundamental piece to this project and how we grow it. We've got $18 million in the bank, so very well funded. We have a very small footprint from the ESG perspective, and I've got some good slides on that. E3 has been focused on building a really solid team. Being in Alberta, having the skill sets we have in Alberta, we're able to hire most of the people that we need to build this project and get us into operations from the local workforce here. The exception to that was Jonathan Nielsen, who we stole from FL Schmidt in the States as a lithium process expert. So he brings that to the team. When you look at the lithium market, and I won't go too far down this train because a lot of people spend time talking about this. In my mind, two fundamental things have happened in the industry last year that have solidified lithium as the metal of choice going into these batteries. Lithium is about 10% of any battery chemistry. And effectively, it provides the lubricant for the electrons. It's the thing that allows the electrons to move freely to power your device and then come back and then discharge when in discharge cycle and then charge back when you're charging it. So it enables the real energy density of these batteries is enabled by the lithium molecules. So fundamental to all of them. If you look at one of the main things that you've seen last year was that almost every OEM in this world has committed to electrifying its fleet, at least in part, some of them in their entire fleet. And so the EV market has now solidified itself. And all of that, the other piece of this is that it's based on the lithium ion battery. There's not a car company out there that is developing their platform based on anything other than the lithium ion battery. So by 2030, 90% of the lithium in this world will be produced for batteries. And that's why it's so critical that you develop a project that has the purity required for direct into battery sales. When you look at what that means for lithium hydroxide demand, E3 plans to make lithium hydroxide. The rationale for that is that North America is going to, with needing range, bigger vehicles. The market for North American batteries is high nickel cathode, which provides higher energy density. The high nickel cathode batteries are produced at higher temperatures and require lithium hydroxide. So the market in North America is expected to be 80 to 90% lithium hydroxide. If you look at the global market, we're talking over 1.5 million tons by 2030. The global market for lithium is over 3 million tons by 2030. And those are, the 3 million tons is actually a Rio Tinto estimate. Looking at the technology that E3 has developed, this is it enables the value for E3. It's pretty important for our development. We've been working on this for 5 years now, and we're getting it commercialized right now. And we plan to have a pilot plant running to demonstrate that in 2022. So just a really quick high level of how this works. And if there's time for questions at the end, if you guys have any, we can dig into it in more detail. Effectively, what it is a water softener. It's an ion exchange process. And we're really trying to demystify this and open up the black box, as it were, to help people understand what this is. It's actually a very simple process method. So the analogy to water softener and other processes like this, ion exchange is used all over the world for uranium, for wastewater treatment, for municipal water, drinking water. It's used up here in Alberta in the oil sands to treat boiler blowdown water. Ion exchange is very, very common as a processing methodology. The real benefits to it are the flow rates. You can flow extremely high volumes. And the other benefit is modular. So if you want to build more, if you want more capacity, you build multiple units. You don't build a giant unit. And that allows you to scale very effectively. It also de-risks your scaling up because you don't have to have this big machine risk. You're just building multiple small machines. So what effectively we've done, and this is operating now in a prototype in our lab today. And we announced, if you saw the announcement we put out this morning, talking about the first set of testing, we did 11 runs to just make sure that the piece of equipment was running properly. It wasn't to maximize performance. It wasn't to demonstrate that this thing can actually perform. We were just doing testing. And even in just those initial testing, we're able to get a consistently over 90% recovery on all the tests, most of them running at 95% in recovery, with peaks seen at 97%. So we're getting very high recoveries consistently across this test, even when we're not trying to. And that just goes back to the performance of what we've developed. So E3's proprietary technology is not the tank itself. It's not the process. It's the bead that goes in the tank. So ion exchange uses little beads. You have them, you hold them in a tank and you flow brine past them. As the lithium molecules in the brine interact with the beads, they stick to them and they swap for hydrogen. This is ion exchange. You're exchanging these ions. So by the time the brine reaches the bottom of the tank, there's no more lithium in the brine. It's all attached to this material. And then we simply put that back into the ground. This is a closed loop system. And it's very low energy because it only requires the manufacture of the material and the amount of energy to pump the brine to the top of the tank. So very, very low energy. Every so often, this material fills up. Another way to describe ion exchange is molecular sitting. So every so often, this material fills up with lithium. You stop the flow of brine momentarily and you backwash off the lithium using a backwash agent. And what we do, and what's unique to E3 here, is that we're able to use significantly less volume of that backwash than the original brine. So we end up with all of that lithium that's attracted to this material in a much smaller volume. So we get this highly concentrated solution. And because the material only selects lithium, we get incredibly high purities. So we remove over 99% of the impurities from the brine, and we get up to 100 times concentration, but in a commercial scenario, we're probably looking between 10 and 30 times concentration. So we have a highly concentrated, highly pure lithium concentrate. And this is one of the key things that enables us to go directly to battery grade, because we have a very small cleanup stage after this, a little bit of polishing to get it to a feedstock that goes through the hydroxide processing, which is industry standard. Looking at where we're at right now with the technology, as I mentioned, we put out some results about our pilot prototype. The goal is that data that we're collecting with this prototype over the next couple of months will be used as the design basis for the pilot. Because E3 is not inventing a process, we're just inventing the beads, which is now done, that R&D development is all complete. We have a final commercial product in that sense. Then the processing around it, what E3 is aiming to do is go to conventional ion exchange processing companies to use their technology to process this. And what that means is that we can move through the piloting stage very quickly if we can find the process that works. And when you look at this from a commercial standpoint, the DLE technology obviously enables this, but the real opportunity is the size of this resource. So 7 million tons, we put out a PA, and I have the economics here in the next slide, outlining a 20,000 ton project. That's phase one. Phase two expands that to 50, and then phase 3, 4, 5 up to 150,000 tons. The biggest producer of lithium today is Albemarle, 80,000 tons a year. So it would be twice the largest lithium producer globally today when we get to full capacity. So the real blue sky opportunity for E3 is developing this resource, and we have lots of it. So if you look at the white outline on this map, that's our permit ground. That outlines the ownership of the lithium rights that we have. That's basically, it's a funny shape because it follows the Leduc aquifer. And we know where it is because there's over 4,000 drill holes into it from oil and gas exploration and development. The dark blue shaded areas on this map are our resource areas. So if you look at that, there's only about 1/3 of our total ground, total Leduc aquifer that we have under resource. So there's a huge expansion opportunity both in the resource base that we have, but also in the total capacity of production from the company. This is what this looks like in schematic. If you're an Albertan, a conventional oil producer in the southern half of the province, this looks very familiar to you because this is exactly how you produce oil. You have multiple wells producing the product from the aquifer. You bring them together and into a central line that goes into a central processing facility. For us, we strip out the lithium from the brine. If you're oil, you're stripping oil out from brine. So these operating parameters exist today and currently moving this brine around today. Now, there's very little oil left in Leduc, very little production left. And we don't plan to produce from the oil area. We're going to go to the other parts of the aquifer. Keep in mind that this thing is 45 kilometers wide and 160 kilometers long. And the oil section is about 1.5 kilometers by about 15 K. So very, and only 10 meters thick of the top 10 meters they produce of oil, where we have the whole 250 meters of aquifer to produce the brine. So way more brine in this aquifer than there ever was oil. But now the oil's gone. So now it's pretty much just the brine left. So once we take the lithium out of the brine, we put the brine right back into the aquifer. So this is a closed loop system. There's no exposure to the brine to the atmosphere. Once we make our concentrate, it goes through conventional lithium hydroxide processing equipment, which is not something E3 is developing. We're going to vendors to provide that to us, and we're doing that development work right now. The 20,000 ton base case for the project outlined an NPV of 1.1 billion with an 820 million after tax, 27% IRR, $600 million initial capital, which is about on par with the industry, about $30,000 a ton, but average. And one of the biggest things that we have advantage to this project is the low operating cost. So 3,656 per ton, which is a little less than half, sorry, a little more than half of what a hard rock mine operating in Australia costs to make the same lithium hydroxide. So very low bottom quartile of operating costs across the globe. Excellent. So talking a little bit about ESG, and I know that this is the focus of this conversation. So that brings us up to where E3 is at. When you look at it from the ESG perspective, relative to how other lithium is produced in the world, producing it like oil and gas actually provides one of the most solid ESG profiles available. And the main reason for that is that there's no evaporation ponds and there's no open pit mines. So that makes the surface impact obviously is much smaller, but there's other peripheral things that happen when you have that sort of surface impact. One of them is interaction with the freshwater aquifers that sit at the surface of the planet. So there's fresh water in most places in this world, obviously not in deserts, but you know, and sometimes in very dry climates, there is fresh water below the surface as well. And when you never open pit mine or you have a evaporation pond, you interact with those freshwater aquifers. Because this is a closed loop system and there is no open pit, there's no evaporation pond, it's all through closed loop systems, all pipes. It all stays within those pipes, it's never exposed to the atmosphere. We do not interact with that freshwater aquifer. Our location, our processing facility is about on par with any other processing facility, but because we don't have that big open area, big mine or salar, we have very small footprint where our wells exist. And those generally, once you've drilled the wells and you've got that running, you generally reclaim most of that back and give it back to the farmer, as I mentioned, so they can continue farming on it. And they farm up to beside the wells and you put a fence around them. So most of the land actually goes back to the farmer and you just have an operating wellhead there. The other big piece of this is the carbon footprint. And when I'm talking to OEMs and battery companies about the carbon, or about our product and about feeding it into their batteries or their cars, the first question they ask me is, what is our carbon footprint? It is an incredibly important metric for all of these companies, and going to a carbon neutral lithium product is a key goal for E3 Metals. And we're currently hiring someone to come in and take that on. We've been working on it with the staff that we have, and we're going to actually bring someone in to lead that, who's a specialist, to get us to a carbon neutral lithium product. And we do that in Alberta in a couple of ways. There is zero carbon power grid, zero carbon power on the grid that we can get access to. There's a wind farm, and you see pictures of our project site, and there's some behind me of wind towers. Those are our project sites. So there's an 80 meg wind farm on the project site. But the real tangible way that we end up going to zero carbon for baseload power is carbon sequestration. And we're working very closely with the Alberta government and some of the companies that are participating in something called the Carbon Sequestration Hub. So this is an initiative that's getting going here in Southern Alberta that will see a carbon sequestration hub be built, and you'll be able to put your CO2 to that hub, and they will dispose of it for you. So without that hub, we would dispose of the CO2 into our own brine stream, which requires us to certify that it's sequestered. But a simpler and more sort of streamlined approach is participating in the carbon hub that are building something that will do exactly that. So that's most likely where this will go. And so we're very excited to see that happen here in the province. Looking at it from a market driver perspective, it's incredibly important because the carbon footprint of the electric vehicle today is actually higher than the internal combustion. And this is a fact that all automakers know. It's more prevalent in Europe, where they're actually taxed on the total carbon footprint, not just what comes out of the tailpipe. And so they need to understand what the total impacts and inputs for carbon are for their vehicles. And so they're on top of this, which is why I'm getting asked this question first off, because it is a very important metric to their cost model because they're being taxed on it. So when we talk to the OEM and the automobile manufacturers, the battery manufacturers, we get compared against other sources of lithium, obviously, as they're looking for supply products. So sustainability has become a driver for a movement of deals and development in terms of offtake and that sort of thing in the battery metals space. And for us, obviously, that's lithium. So one of the ways one of the areas that the lithium market is going is life cycle analysis assessments completed by third parties. They're not very common right now, but I think they're going to be more and more common in the future. And certainly, if you want to prove to the automaker that you have a good ESG score, you need to have some sort of third party independent review of what your process is that the automakers can review. The bigger companies do it internally. A company like us would hire a third party company, and we plan to do that. So when our pre-feasibility study comes out, we'll hand it over to a firm, and they will do a life cycle assessment on it and provide that data to us. And we're working on that right now to understand where the impacts are. And so this is the result of that study that we did last year in 2021, or this year, I guess, but into 2021, talking about where our sources in terms of an ESG impact are. So and where the benefits are as well. So obviously, I've talked about this as well already, but the deep aquifer that we're targeting for this brine has no connection to the surface water. So we don't have any impacts from that. We're not draining, dewatering a pit and having to deal with water and clean that water back up after it's come into the pit and had to be pumped back out again. Or we don't have leakage into the freshwater aquifers. Looking at our pre-treatment and our ion exchange, this is very simple process with low energy, so therefore low emissions. And in terms of acidification, very minor, very small impact there. Our full process has embedded recycle streams. So when we had this assessed, one of the big pluses we got is that we actually recycle the majority of our reagents back through the process based on the flow sheet that we've developed. So that reduces waste significantly to going to almost zero, like landfill waste. And also, of course, emissions have a big part of that, because you're not generating, you don't have to ship this material in, or you're not having to generate it somewhere else. You can regenerate it from your own process. So our final product has a very solid environmental side of this because of all of these impacts. A big part of this, though, is the carbon. And Alberta's grid is not zero carbon. It's not hydroelectric. So for us to get to zero carbon, we need to find other means, and one of those is carbon sequestration. So we plan to have a natural gas power plant as a base load. We can use the heat from the exhaust to run our final stage, which is the crystallization of the lithium hydroxide. So that reduces the overall energy budget. And then we sequester the CO2 out of the exhaust gas, and we get down to carbon neutrality. And then obviously the closed loop system has a major impact to the full process. So as I mentioned, when we get the pre-feasibility out, we'll have an LCA to identify scope 1 to 4 emissions on this. And we're working on community engagement. I mean, so the social side of this is obviously very important. We're in Treaty 6 and Treaty 7 here in Alberta, and that's something that we engage on. And then going forward, obviously the local landowners and the communities around us that we impact, and that sort of thing. So I'm just looking at the time. I've got just a couple of minutes left, so I'll skip this. I've talked about this a lot. Looking at us from a market perspective, we get compared to standard lithium a lot. There's a lot of similarities. There's a lot of differences. Our processing technology is DLE. It is ion exchange, similar to theirs, but we actually have manufactured our own sorbent material, which is different. So the actual heart of what we're doing is different from what they're doing. And we also own our own property, which they have one small property, and their major project is a 30% JV, moving to 40% with Lanxess. But I think the big difference in the two companies is time. So they're about 2 years ahead of us. They've de-risked their processing technology by piloting it in Arkansas, and we plan to do that in 2022. And I think that's a very good value marker for E3 to achieve that major goal. Plans for the next year, 2022, are pretty major. All of our major milestones that the company's been working towards are going to be ticked off in 2022. So this is a very big year for us. So we're getting the pilot plant out the door in 2022. We're going to drill the first lithium wells in Alberta in 2022. We're going to book an M&I by the end of 2022, and we're going to produce meaningful amounts of lithium hydroxide using conventional process methodologies and vendors locally. So that's a huge thing as well. We'll be packaging it up in little containers with our logo on it, sending it off to all of the people that we're talking to in the industry on the supply side for them to be able to analyze and test.
Hey, Chris, we just got a minute or two left here. If you don't mind, we just want to hit you with one or two questions before we have to jump to the next presenter. Sure. My first question, can you just give us a very brief snapshot of the last 12 months of E3 Metals, where you've raised money, how much cash you have today, and what your go-forward cash burn looks like on a quarterly basis, just roughly, just to kind of give investors on the line a frame of reference for how well funded you are today and what the outlook looks like.
Yeah, that's a great question. So, Echelon was pretty critical in the 2021 fundraising. So we did $8 million with the crew here in February. And then we're getting warrant exercises coming in from that as well. So including the warrant exercise, we're probably at about 14 million raised. We've got about 18 million in the bank today. The burn in 2021 was fairly minor. I mean, we built a lab. We got a prototype running. We did a lot of foundational work in terms of a reservoir model and all of that stuff. We've been staffing up. We're still staffing up now to get ready for next year. So I would say 2021 was a real foundation building year for the company to tee us up for 2022 success, which is going to be a big year. For 2022, the burn, we're just in the process of estimating things like the drilling. So we're looking at about 4 to 5.5 million for the drilling that we plan to do. The pilot plant itself, again, we don't have a quote from the vendor quite yet, but we're estimating around 5 million in total, including the operation of that pilot, because it's going to operate for 6 months as a minimum in the first location. So that obviously there's a cost to do that. So we're estimating about 5 million there. And then the hydroxide side of things, a couple of million. So, that adds up to about 12 to 14. And then obviously our G&A and our burn. So we have enough capital right now to get us well through 2022 for the next while.
Thanks for the color on that, Chris. I'll pass it over to Mike. We have to jump here, everyone, on to the next presenter. So thanks, Chris, for your time, and Mike, over to you.
Yeah, thanks, Chris,
guys,
for the presentation there and for the overview of the company. It is 11:30 now, so we'll be moving on to our next presenter. So change the screen share here. Yeah, thanks everyone. We have Simon Clark, CEO and Director of American Lithium here to present this morning. It's another development stage lithium company. I have 2 low-cost lithium projects, one in Nevada, one in Peru. As well, they own one of the world's largest undeveloped uranium projects that's also located in Peru. Companies actively developing all 3 assets in tandem. I have a number of material catalysts upcoming across the entire portfolio. So with that, I'll hand it over to you, Simon, to give an overview on American Lithium.
Thanks, Mike. Do I share my screen, or have you got it there, or how does it work? There you go.
I've got it here.
Okay. So thanks everyone. This American Lithium, if you look at the front page there, it's always good to start with a bit of context. So that's the project that we have in Nevada. It's as Michael mentioned, a large at surface claystone deposit. And in the US, obviously location matters. So just for context, we're south of the sage grouse line in Nevada and north of the desert tortoise. So we have from an environmental perspective, we're very fortunate that we're at 6,500 feet in the high desert, a great location to be building a mine and processing facilities, and no major environmental issues with species or animals or cultural issues. So I just thought I'd start with that. And Michael, if you don't mind scrolling through to page 4, that'd be great. Yeah, so just to give a snapshot of where we are, as I mentioned, American Lithium has been focused on the claystones in Nevada for the last 3 or 4 years, and we've came out with a very large resource and are in the process of moving that to a PEA over the next quarter here. And with the success of that asset and the critical minerals initiatives in the US and a lot of publicity in the space, we obviously had a lot of very good traction in our stock price, and that allowed us to make what we think was a really well-timed acquisition of Plateau Energy that closed in May of this year, and brought in Falcaoni, which is a hard rock, very high grade at surface pure lithium deposit in Peru. And as Michael also mentioned, the world's 5th largest undeveloped uranium project called Macasani. We also, with the help of Echelon, raised 35 million recently. Our treasury, actually, because the stock price has done well, we've had a lot of warrants being exercised, so it's actually more like 57.5 right now. And the Plateau acquisition also was a key catalyst for us in terms of really building out our management team, and I'll talk a little bit more about that as we go through. Michael, if you don't mind advancing, that'd be great. So just a snapshot. I won't dwell on this, but obviously you can see what's happened to our stock price. A lot of that driven by the market and the refocus on lithium, and obviously helps somewhat that LCE is at 29,000 on the spot side today. And you can just see some of the highlights when we acquired Plateau, and you know, some of the work that we've been doing in terms of lithium extraction at TLC has been very positive, and again, raising a significant amount of capital, which really underpins our you know, our plans for the next 2 years here, gives us a very solid working capital position. Thanks, Michael. So just to give a closer snapshot on the share structure, you know, just over $1 billion on the market cap, good cash, a lot of warrants and options in you know, $3 or below most of them, so well in the money. This was very much a retail story up until a year or so ago, and then the last couple of financings we've done, it's very much moving to the institutional side of things. And again, we you know, the last 2 financings have been mainly institutional led, strong support from management and board. And you know, we've been covered by VSA Capital out of London for a couple of years with Ollie O'Donnell there, and Roth Capital initiated a few weeks ago. Echelon were the main coverage on Plateau, and we believe we'll be initiating on this story very shortly. Can we move on? So yeah, thanks, Michael. So there's just a snapshot of the board. Andy Baring's our chair. Andy was a founder of Millennial Lithium, which is brines in Nevada, knows the battery space in depth, and got involved with American Lithium in the 2017-2018 timeframe when it recapitalized and actually moved from being focused on Nevada brines to Nevada claystone, which was very much his initiative, and has worked well. Myself, I've been in the sector now for 25 years. My last major role was as CEO, founder, and director of M2 Cobalt, which was a company that Andy also helped us raise capital for. And that company was taken out in June of 2019 by Jervois Mining. I stayed with them for a year and then came back and joined Andy and his team. The office here also has Prime Mining on the gold side and Apollo Silver on the silver side, and American Lithium is the major lithium story that is out of this office now. As I said, I came back in June of 2020, became a director, and then moved up to being CEO in April of this year. So through the acquisition of Plateau, we also picked up Lawrence Stefan and Ted O'Connor, very strong on the technical side. They built Plateau Energy first as a uranium company and then made the discovery of Falcaoni. And critically for us, took Falcaoni, which is a unique style of mineralization, through to battery grade. And you know, that's obviously been a big success story, and we're using their knowledge and their strength and the team that they put together to really help us do the same thing at Tonopah in Nevada. So they've really been a great addition to the team, and indeed the team of 20 beneath them that we have in Peru, who are very active and very engaged. And then our 2 independents, Alex Akumas and Ben Binninger, both bring a lot of independence and a lot of knowledge in the space. And then management team, just to round it out, we have Philip Gibbs also joined from the Plateau transaction. Philip's a seasoned CFO. Mike Kobler was the original founder of American Lithium, and he remains our GM of US operations. I mentioned the team we have in Peru, and it's headed up by Ulysses Solis, who just very well connected at the government level, but also does a great job with our communities. We've got very strong community support, and he's a key part of that. And then beneath that, we have Graham, VP Engineering, and Deborah Struchacker is worth mentioning. She's a specialist advisor based out of Nevada, but very, very strong on the permitting political side of things, and brings a really strong presence in that regard as we position TLC as a real potential win for the administration in the field of critical minerals. Thanks, Michael. So talking about ESG, obviously the theme of today's conference, you know, I mean, obviously it's a bigger and bigger, quite rightly, box that companies have to tick. We take it very seriously. Indeed, in a place like Peru, you just wouldn't get anything done without having strong ESG in place, and in particular, strong relationships with your communities. And you can see some of the pictures here. So around the Makasani Plateau, where both Makasani and Falcaoni are, we have 6 communities that are actively involved. They staff and run one of our camps for us. As we're in the middle of launching our next phase of drilling, they're providing labor for that. We put their roads in. We do a bunch of stuff at Christmas time, which is upcoming. We also make sure that the communities are healthy. We bring in medical teams to give them medical exams once a year. And so it's a great symbiotic relationship where they are providing us, you know, a lot of support and labor as well as we move forward. And it's pretty unique, just to note on it, that the 6 communities sent their leaders to Lima when I was actually in Peru about 6 weeks ago to meet with the president and very much advocate for the government to give as much help as they can in helping us drive these projects forward as quickly as possible. So community is huge. Tonopah is different. It's obviously first world, but again, it's very much a mining community and a lot of support for what we're doing. And in our PEAs at Falcaoni, you'll see we use hydropower. Fortunately, this part of Peru, water isn't an issue. There's very large rainfall. And you know, we use environmental best practices throughout that PEA. And in Nevada, we've brought on a firm called Minviro out of the UK who do life cycle analysis. And as we finalize our PEA and our flow sheet, they're very much inputting into that to ensure that not only are we focused on the best solution from an economic perspective, but also from an end-to-end environmental perspective. If you could move forward, Michael. So this is just to give you a high-level view of Tonopah. This is where our resource area is, and you can see the concessions we've built. We've not done a lot of drilling on the rest of the land, and that's explained by the fact that in Nevada you're allowed to disturb 5 acres of ground before you have to apply for a plan of operations. We've applied for a plan of operations in January of this year, and that is just in its final phase of public consultation now and will be approved mid to late December, which will then allow us to get into the field and allows us to drill across the project areas. It will also allow us to infill, high grade, and build on what already is an extremely large resource at 5.37 million tons LCE M&I and 1.76 million tons on the inferred basis. And as I mentioned at the top, we are in the process of finalizing an initial PEA, which will be published by the end of Q1 of this year. Michael, if you don't mind skipping forward to the next. And this is just to give you an idea of the deposit. It's, as I mentioned, it's a blanket deposit, sits at or near surface, very much lends itself to conventional mining techniques. And our vision for it is to mine, process, and then backfill as we go along, which again minimizes environmental issues. And critically, it's also worth noting that we're well above the water table, which obviously from a permitting perspective is a key element in the US. Michael, if you're okay moving forward. And just to point out, the other key characteristic of our claystone, every project, every deposit is different. This is a freshwater deposit, ultimately, where the lithium was laid down in a low energy environment. And what that means is it's very weakly bound to the claystone. So you can see in this chart here, when we hit it with acid, we're able to extract lithium in as little as 10 minutes, which is far and away the fastest against our peers. And that's very important as we as we finalize our processing route and implement our flow sheet. Obviously brings a lot of benefits. Michael, I think if you move forward, won't get into these, but these are the three processing options. Because of the nature of the mineralization, we actually have the nice luxury of having several options available to us. We're optimizing those right now, again, with a view to finalizing PA in late Q1. Sulfuric acid is the obvious route, high recoveries, but we're also getting very good results on hydrochloric acid, which with hydrochloric acid, you can actually regenerate some of the acid, which lowers OPEX, and also very good results on a roast. It actually, gives us a very, the extraction rates are a little less, but you end up then with a very pure leachate, which you can flush with water and produce either a hydroxide or a carbonate. And so end to end, the roast may actually end up providing us with the best solution. So we're in the process of optimizing and figuring out which route to go, and that'll then allow us, as I say, to complete the PEA. Michael, next one, please. And this, I mentioned off the top, the plan of operations file. So you can see it allows us to significantly expand the drilling across the core areas of the concession, of our concessions. And this will provide more than enough drilling as we move this project from the PEA phase and into feasibility and beyond. Michael, next one, please. And again, just to mention again, we're positioning this project with both at state level and federal level as a key project from a critical mineral perspective that doesn't have a number of the environmental issues and cultural issues that a number of our peers have. I mean, we do believe that ultimately all of these projects get built and developed, and we believe that Nevada can ultimately supply 20 to 30% of the world's lithium supply from the claystones. But obviously, early on, the administration is looking for some wins, and the benign nature, again, on the environmental and cultural side, I think really sets us apart. Michael, if you could move on. So looking at Falcaoni here, this, again, it's a great asset. We're very, I think we were very excited to pick it up at the time we did. Obviously, when we started negotiating the acquisition, LCE was around 6,500. It was at the low of the cycle, and Plateau had some issues around some disputes on a number of their concessions, including a key concession on the Falcaoni deposit called Ocacasa 4. They'd basically had to go to court to protect the rights of the concessions. And so when we bought it, that was all factored into the stock price. And subsequent to that, to our acquisition, we've actually had a judgment ruling in our favor that the concessions that have been in dispute for the last 2 years actually they've confirmed ownership in our favor very strongly, which is great. That there has been an appeal by the regulators, which we expected, but it's a very strong judgment in our favor and a very strong route forward. So, if you look at the economics of the PEA, it's all based on us owning the whole deposit. And it's a large deposit, again, sits at surface. These numbers are all at 12,000 LCE. Obviously, it's a lot higher today, and I know a number of analysts and people looking at it are applying higher prices to it. But again, the key to Falcaoni is it sits at surface. It's a very thick, pure form of mineralization, a unique style of mineralization. It's in effectively a volcanic glass. And the Plateau did a great job on showing the ability to produce battery-grade lithium from this deposit. Michael, if you move forward to the next slide here. I won't dwell on this. This is just setting out the two cases that are in the PEA. The base case, assuming that Ocacasa 4 stays with the company, and then the alternate case, which is actually what we bought the company on. Our view was, even if the dispute wasn't resolved in our favor, the strength of the PEA and the ability to expand that deposit further and bring on further deposits around it meant it was well worth it. And again, it was factored into the stock price. And Michael, if you move on to the next one, this just shows you where the project is on the cost curve. Again, you can see it extremely strong from an economic perspective in either case. And Michael, if you move to the next one here, we can just see the flow sheet quickly. Again, conventional sulfuric acid leaching. And they got this flow sheet to battery grade on the second pass, which again just shows the purity of this deposit. If you put a step in here, you could also produce a hydroxide if that ended up being what the market was looking for. So, you know, we think a very undervalued hidden gem. You know, we're confident on the judicial side, especially with the judgment we've got. Regardless, this is a large area. There's lots of additional exploration potential and lots of scope to add to this resource as we move forward. And thanks, Michael. I won't dwell too much on Makasani, but you can see a very strong PEA that is now 5 or 6 years old. Ultimately, a uranium project is never going to attract the value it should within a lithium developer. And so our goal with this company at the right time is to spin it out into its own vehicle. We will put some of the management into it ourselves and likely bring in some uranium players from outside and keep a big stake and ensure that our shareholders all have the ability to participate. It's an excellent resource. It's you know, again, this is 5 years old. We're doing work now to update it, which we should be able to bring a lot more of the resource into the actual PEA, because the work they've done on pre-concentration in particular shows the ability to more than double the head grade. So a great asset that we will very much look to maximize value for the company over the 6 to 9 months that are coming up now. Thanks, Michael. And very quickly, this is the work we're doing in Peru. We literally just got our exploration permit to do some exploration drilling on 2 new discoveries about 5 miles west of Falcaoni, and we'll be drilling those over the coming weeks. We will then also infill and extend the Falcaoni deposit, mainly in an area called Tres Hermanas. That'll also allow us to move a lot of the inferred resource to M&I. And we will also do some extension drilling at Makasani, all as we you know, our goal on these projects is to restate the PEA at Makasani and also at Falcaoni. And I'll talk a little bit about that as we move on to the next slide. And in Nevada, as I mentioned, we will finalize our PEA by the end of Q1. So just looking at us on an M&I basis, obviously, you know, one of the biggest companies out there from an M&I perspective, and with the reclassification of resource at Falcaoni and the additional drilling at TLC, we expect that number to grow. And yet we still remain very undervalued on an EV to M&I basis. And Michael, just moving on to show everyone where we are on the market cap. I can't quite see this because the thing is here, but I mean, we look at Lithium Americas as our, you know, as where we can be in a couple of years. They are a couple of years ahead of us. We believe that TLC has a similar capability and potential as Thacker Pass, but without some of the environmental and other issues. And, you know, we believe our South American assets more than stack up with where they are. So our goal obviously is to close this gap over the coming months and years. And then Michael, just to finish off on the next slide. So world-class scalable assets, great locations and jurisdictions, lots of support for what we're doing in both, and lots of milestones, you know, coming up with a PLC at TLC, updating our current PEA at Falcaoni, again for the drilling that I mentioned, but also there's a very large cesium byproduct which is not factored in yet, and also a potash credit, which is interesting in a Peruvian context. So our goal at Falcaoni is get the PEA restated by the end of Q2, and then immediately move this project into feasibility during the second half of the year. a strong team, really built out. We looked at the Plateau acquisition and very much see 1 + 1 equaling 3 or 4. And a big part of that isn't just the assets; it's the team that we now have brought in house and the knowledge on taking these unique styles of mineralization to battery grade. And obviously, we're pretty excited about where lithium is placed and uranium. So we think we're in a good position. And Michael, I think our final slide just shows really why we're here. If we don't get our act together in the West, then China isn't slowing down, and you can just see that with the raft of acquisitions that the Chinese companies are now starting to make. They now control Africa, and they're now starting to make major acquisitions across South America as well. So, again, critical minerals and focused on supplying the West, and we think it's a great time to be doing that. Thanks very much, and happy to take any questions.
Thanks, Simon. Obviously, pretty fulsome work program across all 3 assets. I just want to ask you how you think of each of them. I mean, obviously, the uranium asset kind of stands out relative to the lithium. Could you just kind of talk to, I guess, why you are putting some drills to work at both Macusani and Falcaoni, and what you really expect to come of that, both on the resource side and updating the PEA?
Yeah, I mean, great question, Michael. I mean, we're not uranium experts and wouldn't claim to be, but obviously through the acquisition, we have Lawrence and Ted, who are very strong on the uranium side and built that asset. For us, I think the PEA being 5 or 6 years old, I mean, we're in no rush. I think, our sense is, and we've been told by a lot of people smarter than ourselves, that uranium is set to continue to rise. And so, there's a lot of work we can do in the short term, including, some extension drilling, a couple of other deposits, add to the resource. But more critically, I think, restate that PEA. And again, the fact that we can, through gravity concentration and grinding and some pretty simple steps, more than double the head grade, we can bring in a lot of the resource into the PEA that wasn't in it before. So our thinking is, let's do the low-hanging fruit in terms of the work, really position this well, put it in its own vehicle, and then prepare it for the right time in the cycle to spin out, which our view is probably somewhere middle of next year into Q3. But to be honest with you, we are already getting a lot of interest from a number of groups in that project, and we think we can generate a lot more value on it by that work. But obviously, in the interim, if the right opportunity comes up, we would look at it. Ultimately, Macusani doesn't make sense in a lithium producer. And then, in terms of Falcaoni, it's ready to go into feasibility now, is our view. I mean, it's a very robust PEA. But again, I think by doing a bit more drilling, I mean, obviously the main thing we need to do that is we have to move a bunch of that resource to M&I, which then provides the reserves for the feasibility. And at the same time, cesium, I think, today is at $50,000 to $60,000 a ton. I mean, it's a very intriguing byproduct that just isn't factored in, and potash as well. And then, obviously at TLC, we've got drills doing a bit of exploration drilling now, and that'll morph into our next phase of development drilling early in the new year.
Hey, Simon, it's Clark here from the sales desk. Just another follow-up question we had from the webcast. So there's 2 parts, and I'll try to keep it condensed. But so just kind of your broader thoughts on, clay versus brine or other types of, lithium assets, just kind of your high-level views of pros and cons. But also, can you just touch on some of the lithium market pricing, whether it's South American specific or, the global rally you've seen in Asia? Just sort of shed some light on, the trajectory we've seen in prices year to date, where you don't need to make a price on call, but just some color on what it looks like down south.
Sure. So I think taking taking the lithium price first. I mean, obviously, I think 29,000 is the spot price. It's interesting. You haven't seen the a lot of the industry analysts move their prices much yet, but I was intrigued to see Roskill moving their numbers up to the long-term pricing now is at 25,000 going forward. And that's moved up from mid-teens. I think it was 14 or 15,000. So I think people are starting to recognize that this supply crunch that's coming isn't going to go away anytime soon, and there's not a lot of supply coming on. So, so when I talk about that, that's more in the global context. In terms of South America, again, these are global prices, but I think the only thing I would point out is that Falcaoni, the PA on that was done at 12,000, and it's extremely robust because of the cost to recover. So even if we were to look at a conservative long-term price in the 15 to 18,000 range, it's still, it's just an incredible deposit in terms of what those extra, that extra cost will do. So I think most analysts that are looking at us right now, Clark, are applying somewhere between 14 to 16,000 a ton as a long-term price, and obviously it looks very robust from that perspective. And sorry,
go ahead.
I missed your first part of the question.
Go ahead.
Can you remind me again? Just quickly.
So I just wanted your quick high-level view on clay projects versus brine and other, just your preference.
Yeah, no, listen, I think they're all going to get built. I think the demand says that. I think the issues with brine, we were originally a brine company, and our view is brines don't work in Nevada because the grade isn't there. In South America, there is some great brines. I think the issue in South America in a number of places is conflict with communities over water. And then, hard rock, you've obviously got some great grades there. I mean, I think the part of the issue the Australians might have, and they may disagree with me, is they're so tied to China. They don't have the ability to refine or upgrade in Australia, which is, I think, a challenging model. And so we look at the clay stones. The clay stones are kind of in the middle there. They're higher grades than the brines, but they're not as high grade as most of the hard rocks. But they're at surface. It's a little bit like when gold went from this focus on narrow vein, high grade, and then the open pit, lower grade projects in Nevada drove the growth of a lot of companies like Barrick and Newmont, and we think something similar is going to happen. You've got all this clay stone, it's at surface. You've now got projects proving that you can extract lithium at good prices from it. And so, that's why I said we believe ultimately that Nevada clay stones will provide 20 to 30% of the global lithium market.
Great. Thanks, Simon. That's very, very helpful and educational for myself, at least. We're going to shift gears here, and thanks for your time. And we're gonna jump away from the lithium space and head into RNG. We're going to start with Evergen infrastructure. We have Chase Edgelow, the CEO, on with us right now. I'm just going to bring up the presentation and we'll get started right away.
Great. Thanks, Clark.
Chase, thanks for making the time. Just hang on here. I'll get us up to speed, and then I'll let you kick off the story with Evergen. You can even start with, what is renewable natural gas and how, the history of Evergen, where you've, how you've arrived to where the company is today, and the 12-month kind of look back as to what you've accomplished, and then we'll get into the next exciting events to watch for. So over to you, Chase, and there you go. I'll just move it over to the first slide.
Great, thank you, Clark, and thanks to you and to Echelon for all your support and for having us on the conference here today. We came at Evergen about 2 years ago with a strategy to develop what we saw was infrastructure for two critical sustainability problems in Canada. One was a growing demand for green energy, and I think what renewable natural gas is a solution for the gas grid to take advantage of existing infrastructure and to utilize it to move towards a sustainable future. So what renewable natural gas is, taking a step back, is really any gas that's derived from organic waste. So in our facilities, we take in 3 types of waste. We take in residential organic compost waste, so your green bin waste, if you've got a pickup program in your municipality. We take in commercial organic waste, so this could be from food producers, leftover food, or spoiled food waste. And we take in agricultural waste, being primarily manure and other derivatives of the agricultural process. So with that, what typically happens, or what's happened historically with this waste, is it's gone to landfill. And in landfill, organic waste decomposing produces methane. Methane going straight to atmosphere from landfill produces, there's a lot of numbers out there, but up to 30 times more harmful impact on the atmosphere than CO2. And so capturing that gas is important in and of itself. And then being able to use that gas as a fungible exchange for traditional natural gas in the exact same infrastructure that's been used for the last 50 years is what really makes this compelling. So I'll pause there and just talk about where EverGen's come from. So we built this company to acquire, develop, own, and operate infrastructure in this space in particular, and to be a pure play in this space. And what that looks like is, if you followed the wind and solar space over the past decade, you would have seen a number of independent power producers that started out as smaller developers and turned into multi-billion-dollar companies, being the Northlands, Interjects, Algonquin Powers of the world. And they really did that on the back of providing renewable content to the electrical grid. And they got, in exchange, they got 20-year power purchase agreements, which really underpinned their development, de-risked their development. And what we see is the same thing in the RNG space. We're supplying green gas to the gas grid. And in Canada, there's multiple utilities that are offering 20-year take or pay fixed price contracts to take the gas. And they're taking the gas at prices that are 20 times, in some cases, 10 times higher than normal or traditional natural gas prices, higher than AECO last year, as an example. FortisBC has a mandate to take gas into their system and can pay up to $31 a gigajoule. So that's what underpins the infrastructure side of our business, is having that long-term contracted offtake. So that's part of it. The other parts of the equation is on the organic waste side, and we'll touch on that in the coming slides. But effectively, organic waste is increasingly getting diverted away from landfills, and what's needed is infrastructure on the back end to take that organic waste and to do something with it that captures the emissions. So we've got a team that we put together. We've acquired 3 assets in the first half of 2020. We went public through the summer. And what we see is a space where we can develop our own projects. If we are successful in nothing else, we're looking at taking our EBITDA from around $3 million to north of $12 million, closer to $15 million in 2023. But really, what gets us excited every day is the M&A activity across the country. So we've focused on British Columbia out of the gates, and I'll touch on that in a second, but we see a number of projects that are ripe for development across the country in Alberta, Ontario, and Quebec. I'll go next slide, Clark. To start with our existing portfolio, we have three existing facilities that have been operational for a range of 5 to 10 years for each of them. Net Zero Waste Abbotsford on the left-hand side is an organic waste processing facility. This facility takes in green bin organic waste from 3 of the Metro Vancouver municipalities, and we process that green bin waste into Class A organic compost, which goes back into the agricultural community in a closed loop circular economy operation. And what we saw in this facility was the ability to use that organic waste that was already coming to the facility and expand the facility to capture the emissions from the decomposition process and bring in additional organic waste. So that's what we're doing at Net Zero Waste Abbotsford. We've got a 20-year Fortis offtake agreement that we secured earlier this year, and we received the BC Utility Commission approval for in the fall. That is a 20-year agreement. We get a fixed price. That price, as I mentioned before, Fortis is allowed to pay up to $31 a gigajoule. Our contract terms are confidential, but if you look at where they've been contracting recently, you'll have a good sense as to what that means in terms of impact for our business. The 20-year agreement really means for us that every year we know what our cash flow is going to be out of that asset. And when we look at a combination of getting paid for the organic waste coming in the front of that facility and then getting paid for the RNG coming out the back end, we're looking at a contracted business that is providing close to $5-6 million of EBITDA in 2023. If you look at Fraser Valley Biogas, this is the project in the middle. You can see what these facilities look like when they're built. Fraser Valley Biogas has been operational and was the poster child for Fortis BC's program a decade ago when it kicked off to provide renewable natural gas to their customers. The two tanks that you see on the foreground are anaerobic digesters. So this is where the organic waste goes in on the front end. We'll talk about the process in a couple slides here. But when we acquired this facility, what we were excited about was the development potential. So if you can see in the background, there's a civil work for a third digester. There's another tank that you can't see that hasn't been completed in the background for a fourth digester. So we're developing this project. We're adding 2 new digesters next year, and we're in the process of recontracting our existing offtake agreement that we have with Fortis BC. There's a number of options out there, and the pricing is very attractive at this time relative to where it was 10 years ago. So there'll be a significant uplift in EBITDA at this site as well. And when we look collectively at the portfolio between Net Zero Waste Abbotsford and Fraser Valley Biogas, we're spending approximately $40 to $45 million next year in terms of CapEx. We've got $20 million of cash on our balance sheet. We'll be deploying around $25 million of project finance for the development of these 2 projects. And the construction period is really through the spring, summer of next year. So that's what really drives our EBITDA growth out of the gate. Our leadership team slide here, I think just a little bit about my background and the teams. I don't want to spend a ton of time here, but our focus out of the gate was to be a consolidator in the space. And I think we've got everything that we need to do that. So I came from Macquarie from a background looking at infrastructure projects, being involved in M&A transactions. My co-founder, Misha Zapman, is a lawyer by background. He's been involved in M&A most of his career, and then more recently has been involved in more entrepreneurial ventures and growing companies from small cap into medium cap and exiting those businesses. I think between the two of us, we've been able to attract a talented team around us. Sean Mezzi, our COO, is one of the most experienced renewable natural gas operators in Canada, if in this part of the world, if not beyond. He's been involved in over 60 RNG projects globally. I think probably more than that. It would be fair to say that when you look at the RNG space, I think most people wouldn't have known what it was 2 or 3 years ago. Sean's been doing this for 20 years, whether it was with Green Lane, Zebec, or in the last decade, primarily working with US private enterprises that are growing significantly in the US. I think if you look at the RNG space, I think you look down south of the border, and you can see there's close to $10 billion of public and private companies that have been born on the exact same business model that we have at EverGen in terms of building out infrastructure in the RNG sector. I'll go next slide. So this slide is probably the slide that we like to talk to the most, just in terms of summarizing our business in a really simple manner. If you look at the front end, our projects are taking in feedstock from the 3 different organic sources that we talked about, be it green bin waste or agricultural waste or other commercial waste. We're not involved in the municipal pickup business. The municipalities drop off the waste at our site, and we get paid a tipping fee for that, for taking in that waste. Then we have processing on the front end, and the waste goes into the anaerobic digester, and there we create biogas. We upgrade that biogas into RNG. Biogas is primarily methane and CO2, and then that RNG is connected directly into the pipeline. So this diagram represents what is currently happening, what has been happening for the last 10 years at our facility at Fraser Valley Biogas, and is what we're building at Net Zero Waste Abbotsford. Now, the other part of the process that we don't often talk about is the digestate. So if you look at the digestion process, you basically have gas coming off of the organic waste, and out the bottom you have a liquid stream of digestate, which is perfect for fertilizer. We at Fraser Valley Biogas, it's been going back onto farmers' fields as soil amendment for the past decade, and it's an organic version of fertilizer that the farmers, obviously, especially the ones that are looking to build a more sustainable business, like to use. I would say today they take it, they see significant increases in crop yields, but in Europe, where I think the leaders in sustainable farming are, what you see happening in the digestate space is you see this fertilizer being marketed as a product and it being a revenue stream. I think we're probably a few years away from that in Canada, but I think it's a significant opportunity for the business. And then on the right-hand side, this is just a subset of the market. So we're tied directly into the gas grid at Fraser Valley. We sell gas into Fortis's network, and Fortis then can pass that gas on to their consumer base in the Lower Mainland. But because we're grid connected across North America, it opens up a world of opportunity to sell gas into the utilities in Eastern Canada and also into the US, which is a bit of a different market. We'll go next slide. So this is really our other significant tailwind, is the diversion of organic waste from landfill. And the impetus for this is farmers looking to reduce their emissions. It's municipalities looking to reduce their greenhouse gas impact. And what you need to understand on this slide is simple. It's the green bars are diverted organic waste. The blue bars are organic waste that's currently going to landfill. So BC is leading the way with about a 50% diversion rate. But what we're really excited about is the growing green bars in Alberta, Quebec, and Ontario, where you have continued diversion happening for the reasons that we talked about earlier. And what that means is that you need infrastructure to take this organic waste in, and composting is the simplest option. I think the highest value use, though, for that organic waste is to capture the energy from it, and we're seeing that happen in municipal RFPs. Where the municipalities are actually requesting that the organic waste go to an anaerobic digestion solution rather than just stating that the waste has to avoid landfill. We'll go next slide. We get this question a lot. Why Canada? Why are we focused in Canada? I think it's really two reasons. One is the offtake agreements. I think, again, we're grid connected, but there's priority for Canadian projects into Canadian utilities. So when we look at that, if we can get a long-term 20-year take or pay contract and build a facility that has that long-term reoccurring revenue associated with it, I think over time, you've seen this in the wind and solar space, those assets that have 20-year contracts are valued at a significant premium to those that are selling into merchant markets. And I think that's really the underpinning of our business platform is focusing on the gold standard offtakes that we have in Canada. And then secondly, the feedstock regime. We're seeing increasingly landfill bans come into place that means that there's organic waste that needs a home. And then finally, it's the competitive landscape, the size, the population distribution of Canada being what it is. We see projects that are in the $30 to $50 million size and scale range. And what that means is that you've got a gap between traditional infrastructure investors that like to invest in $100 million plus projects and what we're seeing in our pipeline, which are smaller projects that have similar attributes to the larger projects, but are challenging for the larger funds to come in and play in on a project by project basis. We'll go next slide. Just a quick summary of the terms. This is public disclosure from Fortis. And this is a little bit dated. They've recently received approval to pay a price of up to $31 a gigajoule, so slightly higher than their previous cap. That is regulated by the utility, but by the Utilities Commission in terms of what they can pay. And the reason for that is that Fortis takes this gas in and effectively passes the cost on to the rate base. But they also, and I think critically to what's happening in the business, is that they sell green gas directly to consumers, and they've been sold out of green gas for the last couple of years. They've just started to sell again. If you go to their website, you can look at options to buy green gas. If you're an IKEA of the world, or a Costco or a Microsoft, or somebody that has a net zero target by 2030, Fortis's green gas going into one of your facilities helps you get there. And they've got a greenhouse gas emission calculator on their website that shows that benefit. And they charge a premium for that gas when they pass it on to the customer. So ultimately that's why they can pay a price that's 10 times the natural gas, the traditional hydrocarbon-based natural gas price, is because they're passing on those renewable attributes. We are passing on those renewable attributes to Fortis, and Fortis gets to market green gas to its consumer base. Next slide. So this is our pipeline. This is what keeps Misha, Sean, and I excited about growing our business and what we're focused on. It's the two projects that we talked about, Net Zero Waste Abbotsford and Fraser Valley Biogas, where we're constructing through the spring and summer and fall of next year. We have 4 additional projects that are under evaluation. And if you look at the stack here, that takes us to 1 million gigajoules per year of RNG output. And we're focused on acquiring and developing these projects through the next couple of years. So to have these on stream by the end of 2024 is our goal. 1 million gigajoules per year at, say, $25 a gigajoule for round numbers would be $25 million of annual reoccurring revenue for our business. And we typically see 50-50 splits on the RNG revenue with the organic waste tip fee revenue on the front end. So that's a $50 million annual reoccurring revenue business with these 6 projects, which is just a subset of our pipeline. You can see there's 14 other projects that are on our radar that we're chasing down as well. Our EBITDA margins are 60%. So $30 million of EBITDA is really the medium-term goal here. We'll go next slide. So this is our milestones and catalysts ahead. I think this is really indicative of how we run our business. We want to come out and do what we say we're going to do. The milestones that we attained out of the gate were objectives that we set in the back half of 2020 prior to completing our first raise. We did our first raise at $5 a share. It was a private placement. We did our second raise of $8 million in March for the acquisition of Fraser Valley Biogas. We executed our 20-year offtake agreement with Fortis BC, and then we moved directly into an IPO listing and raised an additional $20 million, which will go to the development of those 2 projects. In terms of short-term goals, really it's starting to order long lead equipment for our construction next year. We're working on additional feedstock contracts. We've been successful in some of those, and we'll have an announcement out on some minor contracts that we signed into Sea to Sky Soils. The medium-term goals, we've got a real focus on negotiating the Fraser Valley Biogas offtake agreement. Just to put that in perspective, that agreement, if it's 500 gigajoules a day times 500 gigajoules a day times $25 a gigajoule times 20 years, that's a $80 million revenue contract for us, where it's contracted, it de-risks the project, and at 60% EBITDA margins, we're effectively adding our market cap into our valuation for that project. So that's a real needle mover for us. And then we move into project financing, formal FID, where we're starting to put shovels in the ground And at the same time, I think one of the things that's really a bonus for us is that there's grant funding available for these projects. So projects can receive up to 30% grant funding, and any grant funding that we receive just allows us to recycle capital into that pipeline that we talked about. I'll go next slide. Slide 12. We've built this company clean out of the get-go. A lot of companies have an ESG slide. We're an ESG company. We've got a social program that we're really proud of at Sea to Sky Soils. We've got 80% First Nations workforce, and that facility is located on Lillooet Nation land, and it's something that we want to replicate in future projects. Go next slide. So this is where we stand today. We've got 13.5 million shares outstanding, a clean capital structure. We had a half warrant with our IPO and at 10.50, and we had a half warrant with our raise in April also at 10.50. But outside of that, it's an incredibly clean capital structure. We've got cash on the balance sheet that will be the equity contribution to the expansion of Fraser Valley Biogas and Net Zero Waste Abbotsford. And between board and management, we own 16% of the company. We're locked up for 3 years from our initial raise. And so we're here to build this for the long run. We really see a runway to grow a company of scale similar to what happened in the wind and solar space. And we're making good progress. So I appreciate all of the support from our analysts. I think they've seen what's happened in the wind and solar space, and they can see a lot of similarities to our business plan. And then maybe I think the next slide or leave a bit of time for questions. Up to you, Clark.
Hey, Chase, thanks. That was great and very concise. We have a few minutes here. So first off, we did have an anonymous question from the crowd, which I'll hit. And so with the comps in front of us here, who are your closest competitors? I think we have one of them coming on right after you, but who do you view as your closest competitors here in Canada? Does that really impact the way you run your business, given the fragmentation of the M&A market? What have you learned? Feel free to just say as much or little as you'd like right now.
Yeah, I think what's really exciting about the space is that if you look back 12 months ago, there were no infrastructure developers in the space. You had Green Lane and Zebek primarily manufacturing equipment, and really similar to the energy business. I think the services companies were first to run, given the demand for projects in the US. I think as a Canadian focused company, there isn't another peer out there that's purely focused on Canada. I think a lot of the reason for that is that there's some really attractive projects in the US, but the projects in the US typically don't have a 20-year offtake agreement with them. So it's a slightly different model. I think when you talk about growth potential or you maybe re-rate potential, when we look at a company like Ametis, that went from around $100 million market cap to $1 billion market cap in the span of a few months last year, and is growing from negative $5 million of EBITDA, to delivering on their projects in 2023. I think there's a lot of interest in the space in the US. I think it really shows the valuation gap between Canadian listed companies and US listed companies. I think from a project pipeline perspective, a lot of our projects are similar to the projects in Energia's pipeline. If you look at their presentation, I think they're adding projects that sort of add typically $6 million of EBITDA. That's typically what we see our projects at, is that sort of $6-7 million of EBITDA, but we're starting from a lower base here, so that those are every project that we add is material to our EBITDA growth on 2023, and I think it's an exciting time to be in the RNG space. So appreciate you having us on again, and I'm excited to listen into the next presentation.
Yeah, thanks, Chase. We have time for one more question. I was just to follow up on this. M&A is something I think that comes to mind when I think of Evergen and how you got here. Just shed some light, if you can, on the Western Canadian M&A kind of landscape. How fragmented is it really? Is it at 4 times EBITDA 2023? How much offense can you play in this market?
Yeah, so it's a great question. We look at I would say 2 or 3 projects a month that are new that are coming our way. I think there's a lot of smaller developers out there that have projects, but don't have access to capital and probably don't have the technical expertise to know what they do or don't know about projects. I think one of the things that we're focused on is being a good partner to existing developers. So where developers have maybe taken a project from a greenfield asset, they've acquired a permit, and they have maybe started negotiation on an offtake, we can bring the technical expertise from our team led by Sean, where we've seen over 60 RNG projects. We know what works, what doesn't work. We know how to save money on areas where you can really come in with lower capex, but we also know where you need to spend money to ensure that you have a resilient facility. And I think that's what turns maybe a project that would typically be funded by a private equity firm into a project that would be funded by an infrastructure company. And when you look at future growth, I think we're a capital intensive business, but we've raised $60 million of equity. We've got a 50-50 debt equity ratio. We've got an ability to continue to grow without going back to the equity markets, and I think we can do it accretively.
Chase, that was awesome. Thanks for your time and all the color and for sharing your story. We're gonna move on to our next story, which is Green Impact Partners, with CEO Jesse Douglas here momentarily.
Great, thanks, Clark, and good luck.
Yeah, thanks, Chase. Take care. Hey, Jesse. Got you there. Okay, how's it going? So our next presenter is Jesse Douglas, CEO of Green Impact Partners. As mentioned, these are a group of folks who are on the same kind of highway as Evergen, slightly different angle of attack, and I'll leave it there. Over to you, Jesse.
Thank you, Clark, and thank you to Chase for that. Certainly like the path they're on, and I believe they'll be successful doing it. So for Green Impact, we are, as you mentioned, Clark, we're taking a little bit different path. We are extremely focused and achieved many of our ESG goals already. We've got great equality, diversity, and equity through our management team and through our board. We are working hard and doing great things with partnerships in the community. And most of all, we are making a massive environmental impact with every project that we take on. For us, we are really focused around projects that are substantially bigger than what we see typically from our peers right now. So we're looking at projects where 6 million would be the ultra low side of what we can do into projects that are.
Hey, Jesse, can I cut you off for 2 seconds?
Yeah.
It's a bit tough to hear you with your mic. If you can just adjust it or just sit a bit closer. Sorry. Go ahead.
Yeah. Is that better?
Yeah, that's better. Thanks.
Perfect. Yeah, we're looking at a couple of standard deviations higher from a scale perspective. We think that's one of the issues with RNG and where it fits. It is extremely important, and to add to where Chase was at, and what's important about RNG is it's the capture of methane. And he mentioned it's 30 times worse than carbon. It is. He's absolutely right in that number. That's at 100 years. It is 120 plus times worse than carbon in year 1 when we put it into the environment. So if we're going to let the organics and anything that biodegrades and creates methane seep into the environment, I don't believe we can make and achieve any of the environmental goals we're setting at any of the COP or Paris-related conferences. It will be absolutely impossible. And so in order to do that, we have to do it on a big scale. And so we've got projects that are capturing enough methane to produce somewhere between 850 and 11,000 gigajoules a day. And to put that in perspective, I believe the largest project in North America is right around 2,000 gigajoules a day. So with what we're building now and working through as we get these all online, we have projects that we can repeat that are somewhere between 4 and 5 times the largest, and between 10 and 15 times decent sized projects that are out there. And we're super excited about that. So as we move on to our investment highlights, like what we have right now, we've got a $2 billion pipeline that we're currently working, either constructing or moving into FID and starting construction within the next year and a half. And I'm going to talk a little bit more as we move on about how we intend to fund that and what we're going to do, but we believe we can execute that without coming back to the market for $1 of equity. And for us, that's because as we move up in scale in RNG, what we're seeing is returns that are not that Chase returns aren't great at 15+%, but we're seeing them at scale move up into the 20 to 35% range. And so we can bring on project infrastructure partners that effectively reduce our cost of equity really, really substantially in order to let us build projects that we can move through as we look to 2025. We believe that we're moving towards $200+ million in EBITDA. We are a very fully integrated platform for us. Our project development team has developed, built and operated over $30 billion worth of assets like this. We've got board management with over 25% ownership in the company. And we also are focused on the initiation and acquisition side of things, although we think that with our current pipeline and what we've got, $2 billion in it today, and the ability to repeat projects with the technologies that we control, we can probably build and sanction between $1 and $2 billion a year in projects that we can finance every year as we move forward here. So we think for us that the pipeline we have, the scale that we have, absolutely makes us a leader in producing RNG. We love the voluntary offtakes in the companies like Fortis. We've got a 10,000 gigajoule per day offtake with them planned right now. But the market does continue to improve. I mean, Chase said it, we're certainly seeing it ourselves. Fortis is capped out at $31. We believe that there's a possibility for the price to improve beyond that as more and more people are looking to move to RNG as some sort of their consumption, whether that be industrial clients or residential, the way that Fortis is working through with everyone. And so we see the price moving up, we see the offtakes getting better, we see the counterparties being just as good as Fortis. And so, yeah, bring us back to that superior risk-adjusted return. We plan to be about 70% contracted in what we do there, and we consider that 70% contract rate. We rationalize a project based upon how its environmental impact will affect what happens from a carbon intensity perspective. So we believe that in anywhere in the world, you're going to see a $50 plus kind of carbon tax of some sort, whether it be from cap and trade or from credits. And so that's how we rationalize our projects, to say, are we rational if you're better to buy our gas at a $50 price, and how much are we making on that? And then we work through what the offtake is for there. But we're looking really to build these for 100 years, not just the 20-year offtake that's there. And so we have to consider how we are decarbonizing energy. We really believe with, and on the next couple of slides we'll show you, but we really believe the development team that we have invested heavily in is best in class by far. Like I said, over $30 billion of clean energy projects developed and built. And for us, that's an important differentiator to what's there, and an important growth aspect to our business, in that we can self-develop with technologies that we own, self-develop and sanction and build $1 to $2 billion a year in these projects. And we see the ability for us to have a multi-$100 million EBITDA stream coming out of our business in 2025. Okay. Sorry, I'm being told that I still can't be heard, so I apologize.
No worries, Jesse. Just take your time if you need to get set up.
Yeah, I'll get a little closer, so you guys have to look at my face closely here.
Yeah, I think it's just the volume on your mic. It's just not catching everything, but we'll try our best here. Which slide do you want me on here? Sorry, slide 6.
Yeah, you're good there.
Okay.
Sorry, I'm just trying to settings, but I can't take the mic volume up anymore, so not sure.
That's a bit better right there. I know your nose is close to the screen, but that's fine.
Yeah, I can't turn it up. Sorry.
Yeah, it's okay. We'll bear with it. Go ahead.
Yeah, so within GIP, our ESG elements and what we're doing is the primary concern of what we're doing. From every development, every acquisition we consider, and every project we build, we really are considering how big the impact is on the environment and whether we've made the social impact that's there. We think that governance is certainly important on everything, but we believe we control governance completely that way. So We look at projects, the current project under construction, we're looking at a carbon intensity score somewhere in the -200 range. And we want our entire portfolio to be truly net zero Earth impact. So carbon intensity just really is the measure of the life cycle of the project. Every piece that we put into it, the carbon impact we make on the full life cycle of our fuel or energy that's produced. And so when we're negative, we're actually removing carbon from the environment. And our intention is to build this multi-billion-dollar portfolio out on a net zero basis over time. Certainly, we're taking the lowest hanging fruit projects right now with the highest negative scores. We won't be able to do that forever. Everything we do as humans creates some sort of level of carbon, but we can do it at a net zero basis. And we think that building that multi-$100 million EBITDA stream over the future years here will make us potentially the world's largest net zero energy producer. Flip to the next one, please, Clarky. Yeah, so we are significant and sustainable in what we do, right? Net zero truly means assessing a full life cycle for us, not just producing a project that is considered to be clean because of the space it's in right now. All of the technology we're using can be wrapped and insured. It is late stage, it's proven, it's in use somewhere. And for us, the great thing is we control technologies that we can deploy, which allow RNG to be at scale that no one else is using right now. No one else has a copy of right now. We can leverage all of our in-house expertise. We've got amazing finance teams. We've got amazing development team, great operations team, and really that drive our best-in-class ESG portfolio. And then from a financial metrics perspective, everything we're looking at today, the lowest returns we're seeing are the mid-teens, and we've got stuff that's nearly touching 40% of what we're looking at. So we think that shareholder value that's driven there is absolutely immense. We can, I mean, Chase talked about it. We're seeing companies go from $100 million to $1 billion, and we think that we're here to show everyone that not only do we intend to do that, but we intend to do more of that. Chase talked a little bit about what RNG was, and so for those that maybe weren't in there for his, consistent with what he said, it is the capture of methane and from kind of the digestion of some sort of bio products. And for us, that's really farm-based is our focus, right? So whether that be farming waste related to the cultivation process or manures, and finding ways to blend them either together or single source in what we're doing. And that allows us to do it at scale. We think that for us, we can take into any one facility about 1 million tons a year of organics, and that will allow us to produce somewhere between 9,000 and 12,000 gigajoules of RNG, and also in some cases allows us to produce other clean energy. So in some cases, hydrogen, ethanols, other things like that. So we think it's important to run the full cycle on what we're doing with those and make sure we get great contracts and how the offtakes look somewhere between 10 and 20 years for a substantial portion of the revenue coming out of those facilities, and then maximize shareholder returns with some merchant exposure because the market is really in need for right now and probably forever of clean energy. Green Gas Colorado right now under construction, 1,000 MMBTU per day of RNG on this one, 10-year offtake on it. We are selling into the LCFS and RIN credit market on what's there. We've run a ton of analysis on this, and even on a completely merchant basis, this project is making somewhere between $15 and $22 million a year. I think $23 million a year on current pricing right now. We're forecasting 19 to 21 that comes out of it. We expect it to be done in 2022 and raising our profile exactly as we're showing on the stage here. We really like these projects. We've got a few more that we're working on. We expect to bring a couple of these to FID next year. And we think it's certainly super important. These projects are a negative 200 plus CI. And so anytime you can produce energy and effectively be removing carbon from the environment, we need to do that. And so we have a massive focus here. And we're seeing for us, these projects typically range between $10 and $40 million in EBITDA just locked up another group of feedstock that allows us to do a project that is about 2.5 times this size. And so we'll finalize that and bring that to FID this year as well. The other major project we'd love to talk about is this one. Where, as you can see, we're sort of saying $150 to $190 million in EBITDA coming off of this one. It's actually probably substantially more than that, but we're being quite conservative in the numbers we're giving right now. This is a nearly $900 million project right now, and we think about 5 times bigger than anything else that's been built in North America, and 2 times bigger than anything else that's built in the world. So we're excited for this. This is technology that we control. We can rebuild this. We're currently working on multiple locations for siting of additional projects this way, and we expect that the way that we finance these is through our infrastructure partners that we're talking to, which will allow us to keep a substantial control of these projects and build them without putting any further equity into them. Important for us here to kind of show the implied equity value of our projects. And when you say a company can go from 100 million in market cap to billions, we certainly see that as a realistic thing for us in what we have for shovel-ready projects and the technologies we control. We see that right now. We believe the cash value of the projects we have ready in 2022 is approaching that $1 billion mark. We think that as we move into 2023, it's above that and grows from there. So when we sit with our team, we see a reasonable path to multi-billion-dollar kind of equity value in our company without having to go back to the capital markets for $1. So the growth here is amazing for us. Substantially contracted cash flow, continually ability to continue to repeat this, and with a best-in-class team and building, owning, and operating, and being in control of what we're doing from a development perspective at scale, we think differentiates us from everyone else in the business today. Quick analysis on stock price and where it's at. Again, we think that the enterprise value needs to move towards the multiple billions as we look through this. We appreciate the support we've gotten certainly from Echelon and the rest of our partners in coverage and getting us out to the market. But yeah, there's a lot we're doing. We think that we have really doubled down on our expertise and our ability to execute, and we're extremely excited about it. Push it back to you. Really, for us, we think the opportunity is now to invest with us and to help us achieve our environmental goal of bringing clean energy to the market here. We think that there's a massive recognition worldwide in the importance of methane capture and RNG. And certainly, we think we've been conservative in what we're communicating to the market and our ability to bring projects there.
Thanks, Jesse. We'd love to try and hit some questions if that's all right with you. The first I just wanted to start off with is I'll leave it on one of your initial slides, but just can you just give us a quick snapshot of your not necessarily your capital structure, but just cash on hand sort of outlook in terms of how much debt you may need to look at underpinning here for these projects, and just sort of how you plan to finance these everything that's in the hopper here for 2022. Just give as much color as you're able to here, please.
Yeah, so currently $25-ish million cash on hand. That is committed for us through projects right now. We will spend all of that in the next year. Plus a little, we don't currently have any corporate level debt. We intend to and will be financing every project somewhere in that 50 to 75% range, depending on the level of contracted cash flow and exactly what it is in scale at each project. But we do not intend to take any long-term corporate debt. Everything will be projects on financed on a non-recourse project level for us. And then from the equity side and entering those projects, certainly the scale is big. We're talking about billion-dollar projects and being able to repeat them. That's a few $100 million in equity each time. But those projects have contracted returns in the 20+% range, and total returns when you consider your tipping fees and your other fuels that come out of them on a non-contracted basis in the mid-30s in some cases. So we have kind of great demand and great options from infra players and equity partners to partner directly on those projects. Certainly our preference would be over time that our stock trades with what the aggregate value of our project is, but it's 10 times lower than it needs to be right now. So so we certainly need to make sure we're realizing the value there, and we do intend to be adding those partners and announcing that over the next couple of quarters in exactly how we're going to execute and what partner we have chosen for us on, whether it be a group of projects or individual projects, for us to realize that execution.
Jesse, it's Mike here. I just wanted to touch on Green Gas Colorado. Just given the project's already under construction, could you speak to why you've chosen to keep some exposure to the merchant market for the RNG, just through the RIN, the LCF credits in the US, and what your views are, I guess, directionally with that market in particular?
Yeah, I mean, we certainly right now, even with our a fairly bearish forecast on LCFS, with the production that we have out of this facility, we ran a lot of analysis and we had a lot of independent analysis run. We felt our biggest risk was just making sure it got to market. So we did our a 10-year offtake that ensured it got to market with a AAA party, and we were willing to take the merchant risk on price because it was so minimal from every single party's forecast. And even looking back on a 5-year basis, I believe our worst years were in that $15-16 million range if we look backwards. And we certainly see the value of credits going up over time as the environmental movement continues to gain traction, importance, and recognition. And so we just felt like we were doing our shareholders a disservice to lock in at today's price, especially with more states coming on with LCFS programs, with Canada coming on with an LCFS program. If we can get this cash flow range or better on a locked-in situation, we will probably do that. But if we have to give much of a discount now while the market continues to grow and improve, we just didn't feel like it was the right thing to do.
Thanks. And I guess just wanted to ask on a couple of projects in your development pipeline, namely the Project Wheatland in Calgary and the recently announced farm RNG project in southern Alberta. Given these are quite sizable projects, just want some color on how you plan to develop these towards commissioning, and I guess what's kind of the next steps from your point of view.
Yeah, so from an equity perspective, we have development partners lined up that will supply the equity that's there and still leave us in a substantial controlling position in these projects. And then from a debt perspective, that there are many debt providers that are there, and we'll announce that as it's there. We don't expect to be paying a lot for that debt, and certainly a spot that conventional lenders and even government-backed lenders right now are committed to lending into. So we're not worried about that. And really for us, we're working through permitting. We're all hands on deck to work through permitting on this one right now, and that really is our kind of our biggest gating item right now is getting that permit and getting this thing under construction.
And as far as I know, like in the US with the credits talked about there, I mean, looking at projects, both of these being in Alberta, who would you expect your counterparty to be on the offtake side of things, and what that would really look like, whether that's fixed price or you'd like to keep some exposure to the merchant market with these?
We will keep some exposure to the merchant market. We think it's important in the growing market right now to not just lock in all of it, but we will make sure that we have enough locked in the Canadian market that our shareholders are getting that 15+% return out of that guaranteed return, and then we'll allow enough for us to possibly get into the 30-ish ranges from the rest that's made merchant. Yeah, we have the utilities. We certainly are seeing midstreamers and producers and major industrial consumers looking at long-term offtakes on this and approaching us, I would say, fairly aggressively to lock up the fuels that these are producing. There just aren't projects that are producing the level of fuel that these are coming out of, right? When we talk about between the Alberta projects, there's no one else in the market that even has a project that they're thinking about that's large. So that is for us a really unique ability to contract with people at premium prices.
Hey, Jesse, just to switch gears away from the details of assets and projects and just more on the capital market side. Granted, you're a relatively micro cap story relative to some of the larger players in this arena, but can you just give us some, give us some color on, your trading liquidity has obviously, been challenging because, in small cap land, that's always, in this space tends to be common. But you touched on some updates with your Q3. Do you want to just, tell us what your efforts have kind of led to and what you're trying to achieve in terms of just, generating more action in your stock?
Yeah, I mean, certainly, like you say, Clark, it's it is thinly traded today, and we think that for us, we're focused on just performing. We're providing those updates on locking up feedstock. We've started construction. We right now have we're looking at 2023 EBITDA in the approaching $30 million range already, which is fairly substantial from the value of our business, and that's with the cash we have on hand and executing what's already under construction, and with what else we bring to the market, we really have a good path to $200+ million in EBITDA in the short term. So we hope that our focus on achievement is going to be recognized, and that there becomes demand to get in to achieve not only the financial returns, but to help us to support us in helping us achieve our environmental impact goals.
I think that's a pretty fair answer, Jesse. You mentioned the cash position, which is obviously very important given again the micro cap nature. But can you just give us a feel? $40 million cash. How much cash do you spend plan to spend this year, as in 2022 upcoming?
We will spend all of that. It is committed between our development pipeline and our projects. We will probably spend a little bit more than that and dig into a revolver that we have, which will be paid back quickly by funds from operations. But we are committed to spending all of that. Again, we have great projects that are there, and we will spend all of that. We anticipate probably in 2022 spending substantially more than that, and so we haven't announced anything yet, and so I won't announce it today, but we do intend to show the market the additional sources of cash we have and the partners that we have over the next couple of quarters.
Great. Thanks for that, Jesse. I'm kind of getting to the tail end of my questions, but just on you are cross-border as we speak, and our previous presenter Evergen is focused solely in Canada. As you're kind of looking north and south of the border, what pros and cons have you picked up in terms of projects dealing with state versus provincial regulators? Any commentary that you'd like to share? Feel free.
Yeah, I mean, I think that in Canada, having the national, the government kind of force a national policy is positive, and it creates that voluntary long-term offtake market, which creates great predictable cash flow. And so we think it's important to be in that market. We certainly need that in order to be a long-term sustainable business. But we think the opportunity for environmental impact and the scale in projects in the US is substantially higher. So as we can do some of those high carbon negative projects, we need to execute those even if the environment isn't quite as predictable. And we think that diversification is important for the whole business. And really, like I said, we are committed to the environmental impact we're making, and we're committed to doing that in a way that provides our shareholders superior returns. But if we don't look on both sides of the border, we think we're really missing out on making sure that clean energy is getting to market.
I was just going to ask you to give an elevator pitch, and you did without me asking. So really good, really well done, Jesse. Thanks for taking the time today to share your story with some of our clients, and we'll be in touch, and all the best in 2022.
Thank you, guys. Appreciate you.
Thanks for your time. I'll pass over to Mike Mueller to bring on our next presenter here momentarily.
Thanks, Clark. Next up is Next Hydrogen. We've got Reveal Afzal, President and CEO of the company, here to present. This is what I see as a very interesting name within the hydrogen vertical. It's now moving towards commercialization. It's green hydrogen electrolysis technology. The company's got over a decade of IP development already behind them. Its platform's been validated on the commercial level, having orders from Canadian Tire. As well, they've recently this summer announced a partnership with Honda and Kia to jointly develop some applications of their electrolysis technology. So with that, I'll hand it over to you, Reveal.
Thank you so much, Mike. Thank you for the opportunity to present at the conference. And thank you all for joining us for this session. Next Hydrogen, we are a publicly listed company. NXH is the symbol, trading on TSX Venture. We are a pure play designer and manufacturer of water electrolysis equipment. As you may know, water electrolysis is simply a process where you take electricity and water to break the water molecule into hydrogen and oxygen. And if you're using renewable electricity to break the water molecule into hydrogen, it's called green hydrogen. We make water electrolysis equipment to produce green hydrogen. What we also have the unique advantage for us is that our electrolyzers are purpose-built for integration with renewable energy resources. So that's been the core focus for us for the past 14 years. How do you make these conventional alkaline electrolyzers? How do you redesign them so that they integrate better with renewable energy resources to reduce the levelized cost of hydrogen? We can move on to the next slide. Thank you. So here's the thesis behind the company. Number one, green hydrogen has many applications, from decarbonizing materials handling equipment. That's already happening, as you're seeing with fuel cell forklifts. Also, a lot of interest in the heavy mobility market, and then some industrial processes that just cannot be electrified. When you look at all the opportunities available to us and some of the mandates around the world, it's already pointing to about an $80 billion market for water electrolysis equipment sales alone by 2030. And there are less than 10 notable players in the space. In Canada, we are Canada's most advanced water electrolysis company and the only pure play water electrolysis company in North America for investors to gain direct exposure to this fast growing space. We have been building electrolyzers since 1990s. If you look at the team behind us, we had almost 15 years plus of experience each when you think about our co-founders in water electrolysis before Next Hydrogen was founded. So deep water electrolysis experience, proven track record in building electrolyzers in the past. And not just that, because you have been building electrolyzers for such a long period of time, we understood very intimately what the challenges are with water electrolyzers. So we decided to look at these challenges and redesign electrolyzers, as I mentioned, to reduce the levelized cost of hydrogen. And the design change that we bring to the market is probably the first real design change in cell design since 1950s. And the design change, we have 38 patents on this. It's been validated first with Atomic Energy Canada Limited, then with Canadian Tire, and we recently announced a partnership with Hyundai and Kia as well. Currently, we are commercializing our 123 megawatt product line. That's just the beginning for us. Looking ahead, you'll see much larger electrolyzers coming out of Next Hydrogen, about 369 megawatt systems. So where does green hydrogen play a role? First of all, there's strong government support for this. About 70% of the world GDP right now has policies in place to grow the hydrogen economy. You're also seeing a lot of new interest coming out of the US under the infrastructure bills, talking about $8 billion to develop hydrogen hubs, as well as a production tax credit of $3 per kilogram for green hydrogen. So it's quite significant, and it's also going to take the momentum that we're already seeing and put it in overdrive in the near term, so we expect. It's not just the government. You're seeing that it's the private sector has really started to move, and that's because of some of the scrutiny around carbon emissions. And we are seeing that firsthand in terms of the large corporations that we are speaking with at this time to decarbonize their operations. Final point that I'd make is, why hydrogen now? So if you think about the hydrogen price, about 80% of that is essentially the price of renewable electricity. And that price used to be 12 cents. Now, in many cases, it's 8 cents, but we are also seeing a lot of contracts come in at 4 cents. And then you have curtailed energy because of growing renewable energy mix. The supply demand mismatch is causing renewable curtailed energy being available for 2 cents. And so the biggest cost component for green hydrogen continues to decline and decline sharply. And then it's the innovations that companies like ourselves are bringing to reduce the upfront capex of these electrolyzer units. When you combine that together, we are getting increasing visibility that green hydrogen could approach cost parity with diesel this decade. And in some instances, the numbers are being quoted by 2025. So that's a very powerful statement, being able to produce green hydrogen at the cost of diesel. And that is why the market opportunity is as significant as it is in this space. So just when we think about the mandates as they stand today, there's and you add up these mandates that you see on the left, they add to about 100 gigawatts of electrolysis capacity to be installed by 2030. And I can just move on to the next slide. And on that slide, you'll see that this 100 gigawatts equates to about a US $80 billion market opportunity by 2030 alone, as you can see on the chart on the left. But this is just the beginning. The middle chart shows that 2030 is just the beginning over here. And so this is not a 5-year play. This is not a 10-year play. This is a 30-year play. And when you start thinking about the hydrogen economy overall, electrolysis is just 15% of this market opportunity. So companies with good electrolysis technology that can get in, they can also gain exposure to ancillary revenue streams associated with this, because this overall market opportunity for us by 2050 for electrolysis alone is 1.8 trillion. That's quite significant in itself, but the overall hydrogen economy is expected to be about $12 trillion. So quite a fast growing and promising growth opportunity for electrolysis companies. So where do we play? There are two areas. So electrolysis equipment like ours can be directly connected to renewable energy farms. And intrinsically, you're speaking about large scale deployment, infrastructure scale, 100 megawatts to 1 gigawatt type of potential over here. And over here, the green hydrogen is produced in hub and spoke model and distributed to customers such as industrial customers such as cement, ammonia, steel, also heavy mobility customers in a hub and spoke model. That's one market opportunity available to us. And we're seeing a lot of traction now in this market. But the market that moved first was the on-site market. And this is where you take your electrolysis equipment, park it behind the customer's fence, and then you produce hydrogen, typically 1 megawatt, 2 megawatt systems, and that's used for materials handling application like what we're doing for Canadian Tire, or trucking applications where you have a captive fleet of trucks that you need to power. So the team itself, if you look at the co-founders, Michael Stemp and Jim Hinatsu, they previously led product development for Stuart Energy. Stuart Energy got acquired by Hydrogenics, as some of you might know, and then Hydrogenics got taken out by Cummins. Similarly, Matt Fairley, that you see our vice chairman, he was actually the chief technology officer of Stuart Energy. So between them, we already had very, very world-class product development experience, and we have complemented them now with Jim Davies as our VP engineering coming from Doosan, Jim Frankwell with 25 years of experience. 25 years of experience with Delphi Automotive, Cessna, GE, high quality. So he's been involved in hundreds of millions of dollars worth of manufacturing operations. And then finally, you have Shane Day. We made a small tuck-in acquisition of his company. And as a result, now we can provide aftermarket service support, not just for electrolyzers and the balance of plant, what we could do previously, but now also compressors, storage, and dispensers. So we can come to our customers with a full solution and provide them with full aftermarket service support for all of their hydrogen infrastructure. There are many, many fuel cell companies, as you can see, including some leading ones like Ballard over here, but still there are very few electrolysis companies, as you can see. And the reality is, electrolysis equipment produces hydrogen that can either be used directly as a gas, or it can go through a fuel cell for motive applications. So quite a big market opportunity available for electrolysis companies. But then when you think about our positioning in itself is quite unique. What we are using is cheaper, more durable alkaline cells But given the changes in the cell design architecture that we have brought to the market, which we believe to be the first real design change in cell design since 1950s, is allowing us to give you the performance that you expect using much more expensive PEM cells, and here I'm talking about higher current densities and also better dynamic response. So it's quite a rare white space that we are occupying with our product. So what's unique about us? When Next Hydrogen was co-founded, the other two co-founders, along with Jim Hinatsu and Mike Stemp, were renewable energy entrepreneurs. And basically what they said was that if you think about alkaline electrolyzers, and they have been around since 1950s, they were made for steady electric current, low operating points, producing a set amount of hydrogen that's used in a downstream process. And when you think about that, it works very well in that application. But when you want to combine it with intermittent renewable energy resources and have these electrolyzers ramp up, ramp down, turn on, turn off, they were really not made for that. As a result, you started seeing new focus on cell materials, and we got PEM electrolyzers in the marketplace. Now they operate at much higher current densities, better dynamic response. But the issue is that PEM cells last about 60,000 hours, alkaline cells last about 90,000 hours, but then PEM cells are also a lot more expensive compared to alkaline cells. So that's the situation we found ourselves in. And we said, is there a way to use cheaper, more durable alkaline cells and change the cell design architecture so that we can give you that performance of PEM? And here are the three unique advantages of our electrolyzers over traditional alkaline electrolyzers based on the changes that we have brought in. First of all, about 2.5 times higher current density compared to traditional alkaline electrolyzers. What this really means is that we can pass a lot more current using the same amount of materials as everyone else. If you can pass a lot more current using the same materials, you're producing a lot more hydrogen using less materials. So that's what reduces your upfront capex. And that matters a lot for renewable energy resources, because with renewable energy resources, you will not likely be operating at 100% utilization rate. And as your utilization rate comes down, so you could be operating at 50% when you look at wind resources, or even lower, the upfront capex starts mattering a lot more. And if you can pass a lot more current through the same amount of materials, then you're reducing your upfront capex. And that's what our design enables us to do, operate at about 2 to 2.5 times higher current density compared to traditional electrolyzers. Number two is the dynamic response. With our design, the electrolyzers can ramp up at 5% per second. A traditional alkaline electrolyzer, or the old ones, is about 5% per minute. So with our design, you can better capture the renewable energy resource. So when this cloud cover goes away and the sunshine starts to shine, you want your system to ramp up as quickly to capture the full renewable energy resource. And that's what our design is meant to do. And the final thing is, because we're thinking about not just the on-site market, but infrastructure scale, large scale deployment of green hydrogen solutions, you have to have a design that's intrinsically scalable. And that's what our design allows us to do. And we can make these electrolyzers really big while operating at high current densities. And if you can do that, then you benefit from significant economies of scale. So to sum this up, high current density resulting in less material use, better dynamic response allowing you to better capture the renewable energy resource, and inherent scalability leading to economies of scale. It's a very powerful combination to reduce the upfront capex of these electrolyzers and hence reduce your levelized cost of hydrogen. The design itself, I won't go into too much details over here, but what you see on the left is a traditional alkaline electrolyzer design, and on the right is our design. With the traditional design, you produce the gases, hydrogen and oxygen, in the structural plates that you see on the left, the golden rings, and then they have to be separated from the fluid being the electrolyte outside the stack. So you have the fluids and gases being separated outside the stack in external gas liquid separators, and then the fluid coming back. This can lead to choke points when you try to pass too much current through them, or when you try to make these systems big. So there's real challenges with fluid and gas flow management if you want to operate at higher current densities or make the systems large, or even dynamic response. So what our solution on this was that we decentralized and internalized fluid gas flow separation. So we are separating fluids and gases right on top of the cell plate. And that's how we have debottlenecked these fluid gas flow choke points and have 38 patents on our very unique design. And that's what's allowing for those three unique features that I talked about: higher current density operations, better dynamic response, and inherent scalabilities, all geared towards reducing the upfront capex of these electrolyzers. This is the system that you get from us. It's a full system, comes in ISO containers. It's a plug and play system. We'll have the electrolyzer module in it, the balance of plant, the water purification system, and on the left that you see, the stack that you see, that's our electrolyzer module. This is our 1.8 megawatt system, and then the ancillary equipment associated with that. One thing that I should probably mention over here is that we have an open architecture. So what we are basically focused on is the body of the car. The cell materials, cell components, we have an open architecture. As new innovations continue to come into that, we can drop them into our electrolyzer and continue to benefit from that. So that's a big advantage for us. Our commitment is that given how we have redesigned the cell design, we'll be able to push these cells a lot harder and in a much more optimum fashion to reduce the levelized cost of hydrogen. So far, these are some of the commercial testing that we have performed. Our first project was with Atomic Energy of Canada Limited, as you know, a very well-recognized R&D institution for the whole country. And this is and the comment from them from the public filings is below, where they talked about publicly praised our demonstration with them. The second project that we did was a 0.4 megawatt product with Canadian Tire. Canadian Tire has demonstrated strong commitment to sustainability, and we're very proud to be their partner. We demonstrated our first unit, a 0.4 megawatt system at their Brampton, Ontario distribution center, where they were testing out new forklifts that they were buying at that time. And on the back of that, we were able to secure 2 orders from them, both about 1.8 megawatts. The first 1.8 megawatt system is going to the Bolton, Ontario distribution center. It'll produce about 650 kilograms of hydrogen per day, sufficient to power about 200 forklifts twice a day. And this is going to be one of the largest installations of an electrolysis system for materials handling application on site, to our knowledge, in North America, but maybe even globally. So we are looking to do this demonstration, this 1.8 megawatt demonstration in early 2022. And on the back of that, we have secured a second order as well, which we are hoping to deliver later in 2022. Moving on, earlier this year, we also announced a partnership with Hyundai and Kia after due diligence by them. And the reason why they selected us was because of our high current density operations. So once again, shows how unique our design is and what this design can do in terms of reducing the levelized cost of hydrogen at large scale. Our patent portfolio, won't spend too much time on this outside to say that we are well covered globally. Number 2, from a second family of patents, power delivery, you can see that we were truly focused on green hydrogen market since 2008. And now we have a product that meets a well-defined market need, but really speaks to the commitment of our co-founders during this time period. And now we have a product which is very much in need. We can move on. So this is our focus right now. Right now, we're commercializing a 1 to 3 megawatt product line. But as I mentioned, we are very, very IP rich. And following our recent capitalization, we are well capitalized to not just bring this 1 to 3 megawatt product line, but also scale it up to 3, 6, 9 megawatt systems, which will not just lead to economies of scale, but also benefit some of these large scale opportunities that we're seeing in the marketplace. Number 2, in terms of strategic partnerships, I think we're doing very well already. We have one partnership with Canadian Tire that gets our foot in the door in the distribution market. You're seeing Plug Power, they have a $25 billion valuation focused primarily on the distribution center market. And we have partnered up with Canadian Tire over there. The heavy mobility market, we have partnered up with Hyundai and Kia. They are the most well-known company, right, in OEM in terms of pushing a hydrogen-powered heavy mobility applications. So we're very proud to be Hyundai and Kia's partner, and we're looking to add additional strategic partnerships in different niches so that we have a strong go-to-market strategy for our systems. In terms of people, now we are at about 43 people in the company, and targeting to be at about 60 by 2022. We recently moved into our assembly facility. We can do about 20 megawatts on one shift and up to 40 megawatts plus at this facility. We just recently finished building 2 systems, and both of them were built using our ERP system. Very tight shareholder list, as you can see. We have about 26 million fully diluted share count, strong insider ownership of about 26%, about $44 million of cash on the balance sheet, and no debt. And this provides us with ample capital for roughly 2 years. So just to summarize, Next Hydrogen story, we are one of few electrolysis companies, notable electrolysis companies, with exposure to an $80 billion addressable market. And this market opportunity is only expected to grow. Number two, we have a very unique cell design architecture that is purpose-built for integration with renewable energy resources at scale to reduce the levelized cost of hydrogen. And how we do that is through higher current density and inherently scalable design and superior dynamic response. We are commissioning one of the largest green hydrogen fueling stations for materials handling applications in North America in the very near term. And we intend to scale up our technology to roughly 9 megawatts by 2024. And with that, I'll bring it back to you, Mike.
Thanks, Raveel. There's obviously been increased interest in hydrogen. COP26 just ended. A lot of focus on green hydrogen, and that's where you guys sit. Like next year, 2023, very pivotal years for the company, deliveries with your larger scale electrolyzers. As I see it, your technology really fits in a unique bracket, like kind of between that PM systems and alkaline systems. Just wondering, like, do you have, or do you feel like customers have any preference towards any of those end members? And like, is there any hesitance towards you guys just because it's alkaline based, despite really solving a lot of the issues there?
Well, actually, no, we are finding a good reception from customers on the alkaline systems. For example, if you look at ThyssenKrupp's contract that they won with Hydro-Quebec, it's about 88 megawatts, it's alkaline. Another really big project in the city of Neom, Saudi Arabia, it's alkaline systems. So when you're looking at large scale infrastructure like solutions, you're seeing alkaline systems definitely dominate that market. And why is that? It's because they're using commercially proven materials that have been around for a very long period of time. So there's less risk of scaling up this technology in large volume production associated with this. The next point I'd make is that there are significant improvements that you're seeing in alkaline cell materials, cell components that we hadn't seen for decades. And now if you look at the last 10 years and Google the patents on PEM electrolyzers, you'll see a lot of them. But now you're seeing a lot of new innovation come on the alkaline side. And what that's giving us confidence in is that where these cell efficiencies are, polarization curves are, they're only going to flatten and improve over time on this alkaline side. So we think it's good. One other point that I would make is we focus on the body of the car. So, you know, think about alkaline versus PEM as engines. So we have patents on both alkaline and PEM. So we are really cell agnostic, but given what we are seeing in the marketplace right now, we think we have a product that's going to meet a very well-defined market need. And you're going to see strong reception of alkaline systems, especially because we are less sensitive also to other things such as water purity.
You've got a durability advantage with alkaline systems as well. You know, you have about a 50% longer life, 90,000 hours versus 60,000 hours for a PEM system. So when you're looking at the overall levelized cost of hydrogen, you know, over a 15, 20-year period, that really comes into consideration.
Thanks. Those are good points. And I guess to tag on to that, you've mentioned, I mean, the partnerships and orders, companies like Canadian Tire, Honda, Kia, obviously pretty important for a company at this stage, gives a lot of validity to the technology. Just want you to speak on like what you expect out of the Honda Kia partnership, what that could potentially translate into sales in the future, and what you, I guess, ultimately hope to gain from that relationship.
Yes, so let me back up and talk about what this relationship is about. We are bringing our cell design, our IP to this, and they're bringing their supply chain. Some of the new improvements we are seeing in cell materials, cell components, and combining that together, we're delivering a new electrolysis system to them, a proof of concept system in Q2 22 to South Korea. And on the back of that, we would expect scale up of this electrolyzer and potentially lead to a much stronger, deeper commercial relationship between the two entities. Now, when you think about Hyundai and Kia, they're rolling out heavy mobility vehicles. They're also thinking about light passenger vehicles. So there's a lot of opportunities to deploy hydrogen systems with them. And then Hyundai, let's not forget, it's also an industrial company. So it also services industrial customers. So they could be a strong go-to market partner in different geographies as well as different applications. But for me to say where exactly that relationship will go just now, I think it's premature. We have to do a good job on delivering the proof of concept system to them and make sure there's good alignment on a future path. And we think it's a very promising relationship, and we're grateful for their support.
That's a good answer. And now, like, you recently opened up your assembly facility there in Mississauga. Just if you could touch on like how you'd be able to ramp up throughput at that facility. Like, demand would be increasing. Like, I mean, 2022, you'll be delivering your initial commercial units. 2023, obviously expecting some scale up, and then even more so beyond that. Could you just speak on what you're able to do at that facility alone?
Yes, the first thing I'll mention is we are thinking about large volume commercial sales beginning in 2023. So everything we're doing that with in mind. And one of the first things that we did as a result of that was implement our ERP system, because without a strong ERP system through which you're managing your supply chain, you're going to run into some serious challenges. So it's already implemented, and we built our last two systems using our ERP system. So that should give some confidence that we have some of the infrastructure that we're laying out in terms of scaling up our design. The second point I'd make is we are not really manufacturing these systems, but we are actually assembling these systems. And that is a much more capital-light business model compared to manufacturing. So just to put this in perspective, for about $3 million, I'm getting 20 megawatts of capacity on one shift. And as I mentioned, we can run up to 3 shifts at this facility for $3 million. So think 50 megawatts versus for 50 megawatts, which in today's dollars equates to about $50 million of revenues, using about $3 million of upfront capex. And we have the potential to continue to, in a capital-light manner, open up new assembly facilities to scale up, and especially if you have the backbone of a strong ERP system behind you. And when you think about the people we have in our manufacturing, starting with our VP manufacturing coming from GE, Delphi Automotive, Cessna, our manufacturing manager coming from the likes of Toyota and Air Liquide. These are all people that have been involved in hundreds of millions of dollars worth of assembly operations. So I think we are well positioned to scale up. And then our supply chain, we don't have any rare earths or rare metals that we're using in there. It's mostly base metals in there, which also provides added comfort when you think about our scale up. And our supply chain is very similar to what you see for chlor-alkali chemicals.
Hey, Raveel and Neil, thanks. I just have one added question. Investors are constantly looking for incremental catalysts and significant milestones, as you highlight here on the slide in front of us. There's 2 or 3 significant milestones that you can point to watch for in 2022 or until the end of 22. Can you make those crystal clear for everyone watching?
Absolutely. I mean, our number one focus is demonstrations. And one of the more difficult things with demonstrations is finding good sites to have those demonstrations. Well, we are very fortunate that we have already secured 4 sites for demonstrations for 2022. And we're looking to secure 1 more. We think announcements on these demonstrations is going to be a very strong positive for the story. And in addition to that, there's a lot of strong interest from large blue chip companies to partner up with electrolysis companies to decarbonize their operations as well as of their customers. And we're hoping that we can sign up a few more strategic partners, which will give increasing comfort that we can be a global player in the space. I think Hyundai and Kia is a good prelude to that.
Thanks for the color. That's all the questions I had. Mike, if you have any others before we switch over to our next presenter.
Maybe just looking at slide 2, you're talking scaling up your modules from 1.8 megawatts to 10. Could you talk, I guess, what that would look like how you scale that, like what's really involved in that process? Is it creating a new electrolyzer? Is it basically just tacking on multiple multiples of your current commercial unit.
Exactly. So yes, it's not a new electrolyzer by any means. It's exactly the same electrolyzer, roughly the same length of an electrolyzer, just taller. So it's taking what we have as building blocks and building and using that to scale up. And the key advantage is what we're targeting is to get a cost for electrolysis equipment down to about $400 per kilowatt by 2025. So if you can think about $400, $500 per kilowatt and 2 cents or 4 cents electricity pricing, you have green hydrogen for about $3 to $4 per kilogram. And diesel right now in equivalent terms is $2 per kilogram. So without any carbon taxes. So it's quite a powerful story going into even the first half of this decade.
Great, thanks for that. Thanks both to you, Reveal and Neil, for that. I think it's time to move on to our next company now. I see we've got both Raghu Colombi, CEO, and Kelly Owen, CEO of PowerTap Hydrogen here on the line. So obviously, this is another name in the hydrogen space. PowerTap's focused on its on-site hydrogen fueling technology. It intends to deploy this initially in California. There is in California what's called a hydrogen refueling infrastructure credit system there. This aims to offer some incentives to hydrogen infrastructures like PowerTap, really to solve the chicken and the egg problem overhang on the hydrogen fueling infrastructure currently. So with that, I'll hand it over to Raghu and Kelly to go through an overview of PowerTap and the opportunity it sees in the space. Oh, Raghu, you're on mute.
Sorry, hi, can you hear me?
You bet.
Yes.
Yes. Who's controlling the screen?
That's me. Where do you want me to start?
Okay. Maybe start on the second slide. And yeah, right over there. So thanks everyone for joining Kelly, Owen, and I to talk about the PowerTap story, which is focused, as Michael had mentioned, on the challenge of the infrastructure and the fueling and refueling networks. Just to give a context, there are currently under 100 operational hydrogen stations in the United States and Canada, and that's versus thousands and thousands of battery electric vehicle charging stations. And the U.S. Department of Energy has noted that thousands of stations are needed to meet the coming demand for hydrogen vehicles that we'll talk about here. This first slide just talks about a bit of the history of the PowerTap technology. While PowerTap, the company itself, is under 2 years old, the technology that we're basing our PowerTap 3 platform that Kelly will talk about a bit later has been developed with significant funding over the last 20 years, including funding from the U.S. Department of Energy, Hess Oil, and Renault, the automaker. We acquired this technology last year and have been working hard to upgrade the generation 2 that's already been deployed in the field in the United States to the generation 3 that will launch in 2023. And so I think a couple of significant commercial pieces that have been accomplished in 2021 has been a partnership, our first station partnership with the Andretti Group, led by Mario and Michael Andretti, who own over 100 stations in the Western United States. Our initial stations will be deployed in Northern California. We've also announced a partnership in the Middle East, and which they have taken a clear view towards trying to transition and hedge themselves, given their big supply of fossil fuels. They are looking at green energy, so they're quite optimistic that will lead to some specific deployments. And we continue to have corporate development discussions with parties around the world. Next slide. I think we can go to this slide after this one. I think everyone knows about the opportunity. And again, PowerTap, we're focused on the hydrogen infrastructure. We're focused on blue hydrogen, which uses renewable natural gas and natural gas to make hydrogen on site. The key differentiation of our technology is having a small footprint on site production. We are by no means against green hydrogen. In fact, we're a small shareholder of Next Hydrogen that presented right before us. We take a view that the hydrogen infrastructure is going to be very geographic. It's going to depend on the cost of electricity, the greenness of the electricity grid, and the available of natural gas in a specific geography. And our view is certainly for the United States that blue hydrogen is going to play a key role in terms of bringing cost-effective hydrogen over the next decade. Next slide. Perhaps some of the other speakers have talked about this prior, but it's important to note that it's our view that hydrogen has some real advantages versus gasoline and diesel, and we'll talk about both markets, the consumer market and the Class A commercial market. But certainly in terms of driving range and time to refuel, forgetting any subsidies and such that fleet owners are going to get. Our view is that certainly the Class 8 vehicle market is going to be dominated by hydrogen. There was a recent conference in Los Angeles a couple of months ago with all the major truck makers, and it was mostly significantly all focused on hydrogen as the alternative next generation clean energy solution for trucking. Next slide. Yeah. And it's our view that also that blue hydrogen using renewable natural gas and the carbon capture system that Kelly Owen will talk about a bit later has a very clean footprint, and depending on the geography can be cleaner actually than electrolysis itself. As an example, if you take a look at the Canadian market and look at Quebec, and I'm a native of Quebec myself, has Hydro-Quebec has the largest, one of the largest green electricity infrastructures and low electricity. That's why a lot of the crypto players have been positioned in Quebec itself. That perhaps is a green hydrogen market. If we look at Alberta, however, with its abundance of fossil fuels and natural gas, Alberta is likely a blue hydrogen market. And so we're focused on those blue hydrogen markets, which we think are the majority of the North American markets currently. In terms of the vehicle market, there are hydrogen cars on the market. Toyota has a car called the Mirai, which is available in the Western US, and BMW and Hyundai are coming out with commercial cars. It's at least PowerTap's view that that's not necessarily the largest market. If you think about it, the advantages of longer driving and quicker refueling, which are the significant advantages of hydrogen fuel cell vehicles versus battery electric vehicles, won't apply to the significant amount of the marketplace. It certainly will apply to some people, and also think gig workers, Uber drivers, Lyft drivers and such. Perhaps it'll make an entrance within that marketplace. But we think that the bigger market is on the is on the trucking side, the long haul trucking side. All the major established truck OEMs, Toyota, Daimler, Volvo have made announcements and are launching hydrogen vehicles, and startups, including companies like Nikola Motors, are planning to launch their vehicles in 2023. Again, it's this chicken and egg that Michael talked about earlier. The vehicles are coming, but there's a lack of infrastructure. And again, taking a look at our solution versus some of the alternative solutions out there. Again, green hydrogen does make sense in certain markets, but where electricity is very expensive, it's just not a cost benefit. The solution does not have a cost benefit in certain markets currently, unless there's significant electricity subsidies, and that includes major markets like California. The current model of most all the stations in North America involve shipping industrial hydrogen in trucks to stations that have large storage facilities that take a large footprint. It's not very efficient. There's been challenges in the California market with stations running out of hydrogen. And so we believe that the unique PowerTap on-site hydrogen production solution is cost effective. We make hydrogen on site. We can do it very cost effectively currently with our version 3 that will be coming out. And we believe it's an important step to drive down the cost of hydrogen to make it competitive to diesel and to gasoline. And again, this is just showing that our footprint is a small footprint that can fit at existing stations. Our partnership with the Andretti's and others will involve putting our stations that exist, our PowerTap units on existing gas station and truck stop spots. We need about 1,500 square feet. Given that there's over 100,000 gas stations and truck stops in the United States, there's a plenty of a size of market to find an addressable size footprint for our launch. And again, we're launching in California because it has the best incentives for us, and it's the most advanced clean energy market. However, we do have a plan to head east from here. And again, while we're certainly not negative green hydrogen. We have exposure to green hydrogen as a company in terms of investments and partnerships. The reality is that the challenge in the United States is that the electricity grid is not very green. It's mostly fossil fuel based, and so the idea is that the holy grail, perhaps for green hydrogen, is using wind and solar power to make hydrogen. In the United States, that's a long ways away, even with the infrastructure bills coming out. And so our view is that to get cost-effective hydrogen in most markets, it's going to take a combination, but certainly led by blue hydrogen. I'll talk a bit about some of the government incentives that are important from a perspective of this business. One of the main challenges in this chicken and egg type situation that we exist right now is that we don't know exactly when the OEMs are launching their vehicles. There's lots of public announcements. We have active dialogues with a lot of the large OEMs, letting them know that we're out there and we're launching, but we simply don't know when they will be launching itself. If you can go to the next slide. What's very interesting is that California launched in 2019 a very unique carbon credit under the LCFS program called the Hydrogen Infrastructure Credit or HRI credit, which we get paid in terms of carbon credits that are tradable in the markets, even if we don't sell any hydrogen, as long as we have available capacity. That's a big part of our model to go out and start deploying units in 2022 into 2023, recognizing that the trucks will be rolling out starting in perhaps 2023, but if there's any delays, we still get significant revenues while we wait. And obviously that's how Tesla was built. Tesla's generated over $2 billion of probably straight to EBITDA revenue from similar type carbon credits. And so it's an important part of our business model. This is looking at roughly at a single station opportunity. And we'll look to build stations for about $7 million a station. That price will drop as we get economies of scale. With the combination of equity, there are very attractive debt programs in place from the DOE and others that we're in discussions over. And without even selling any hydrogen, we can generate over $2 million of per station per year, even if literally no hydrogen is sold. And that's a big backstop to our model. Obviously, as hydrogen gets sold, we still continue to get carbon credits, state and federal, that are very similar, which effectively lower our cost of operations. And the revenues per station can go north of $3 to $4 million a station. So it's a very attractive model moving forward. I'm going to turn it over for next few slides to Kelly Owen to talk about our PowerTap 3 technology and what's unique in it. Kelly? Is Kelly on mute?
I'm not seeing her on the
Is he on?
the live attendees here.
I don't see him on any more. He was some time ago.
Okay. Well, certainly I'll take a shot and I'll run through it. And so, you know, the technology itself has is steam methane reformation, which takes a combination of natural gas and renewable natural gas, which will come from the pipeline, and runs through to generate hydrogen on site that is stored on site. We have some very unique technology around compression and storage that Kelly Owen and our engineering team have developed, and so while we have IP that we generated when we acquired the PowerTap portfolio, the PowerTap 2, the PowerTap 3 is very unique. And in industry discussions that we've had to date within parties in the United States, Canada, and abroad, there's been very positive reactions to this new technology that's been developed over the last year or so. Next slide. You know, I think that just talking in general about on-site versus off-site technology, our view is that the on-site solution is necessary to have cost-effective hydrogen. There's not a situation where, with the cost of shipping and transportation, that you can end up with, in our opinion, cost-effective hydrogen. Currently, we know the numbers for the cost of the people who own individual stations that are buying hydrogen offsite. They're paying about $9 to $10 a kilogram and selling it for 16 to 17. Our view is that we can make hydrogen for $3 a kilogram and under, and certainly even with a significant markup, we can bring the cost of hydrogen down significantly to $10, $12 a kilogram, more towards where it has to be to make it cost effective particularly for truck owners. Next slide. Again, the IP that we have is both IP that we acquired, issued United States, Canadian, and international patents, and then new IP we've developed in the development of this PowerTap 3 technology. If we take a look at some of our press releases that we've put out over the last 6 or 8 months, there's lots of details in terms of some of the unique attributes of this technology. I'm sorry, our CTO is not on the line, but certainly I'll make a note that we've had significant positive reaction to it from both current partners we've announced and other partners that we're under discussion with. You know, our team is management team and advisory board are very broad based in terms of skill set and experience. You know, my background's been as an entrepreneur with both private and public markets over the last 25 years. I've been involved in several exits. I am a Canadian, even though I live in the United States right now. Kelly's background has really been as our sort of deep thinker and vision around the PowerTap technology, and he's played a key role in driving our engineering team to develop this new IP, which is PowerTap 3. We have strong presence in all the industry associations. So PowerTap, certainly within the United States and California market, is a known brand to all the OEMs and all the players because we sit on industry boards right now, hydrogen industry boards. And really just as a summary slide, we're focused on the missing link, we believe, within the hydrogen infrastructure, the hydrogen industry right now, which are fueling stations, and that's all we're focused in on. We believe this wave of hydrogen, and there's been several waves over the last 20 plus years since Ballard Power launched in the 90s. We think what's different today is that the OEMs are taking a clearer view towards hydrogen, and the economics matter. And I think in terms of when we've discussed with fleets, and we've had several conversations with large fleets around why they're making conversions to hydrogen, there are hard dollar reasons because they get government incentives. There are frankly a lot of soft dollar reasons. ESG and their stakeholders are demanding clearer footprints. And so we see the large players ranging from the UPSs to the Anheuser-Busch's and such, making significant transitions from their diesel-based trucks to hydrogen trucks over this coming decade. I think with that, I could turn it over to questions, Michael.
Hey Raghu, it's Clark here from the sales desk. Just one quick question.
Sure.
You highlight the existing model relative to the proposed power tap model from a cost perspective. Are there any state kind of regulatory or legislation headlines you can point to, or events we should be watching for, where you're going to see the doors open a bit on storing hydrogen on site? Are there any hurdles left in any of the states that you're looking to operate that you can kind of just educate us on a bit?
Yeah, so certainly we've had conversations in California. California has full mandates and rules around hydrogen stations. Frankly, the other states don't as much. We think a lot of them will start adopting California's rules, but certainly there's nothing that prohibits us from making it on site. It's new, but we've spent the last year explaining. And frankly, one of the 40 or so stations that are operational, public stations that are operational in California, is a Power Tap 2 station at Los Angeles International Airport. So the industry association, the governments are aware of it. Ours is just even a smaller, more streamlined footprint. So we don't see any negative view. In fact, we've had positive views towards it because it's something unique. And the idea that the supply chain risk that we believe that exists with the compressed storage deliver model, which is that offsite production model that's prevalent in the market right now, the fact that we can address that issue is a significant point. In 2019, probably about 6 months before the pandemic, there was a major outage in Northern California, and Toyota Mirais couldn't get filled up. So caused all sorts of issues for Toyota and such. And so this solution is a practical solution for both logistics perspective and from a supply chain perspective and from a cost perspective.
Just one more question for me, and thanks for the color on that. But obviously California is your core focus today. Are there any other states on the radar that you'd be willing to, kind of talk about, or is it far too early to even think outside of California yet?
We think, if we look north to Oregon and Washington, they tend to follow California. The Andretti's also, as a partner, have some stations up in that region. Those are the markets talking with the hydrogen industry. We think that will be the next ones to come out with similar LCFS type programs. Initially, we're going to look at states where they're the best type infrastructure benefits to do so. California is where a lot of the OEMs are certainly launching their vehicles in the United States, but certainly a hydrogen highway needs to be built up and down California, and then north, but then east towards Texas. So I think you'll see us looking at the states that are the heavy trucking states as major spots in the long run where our network will be deployed.
Good, thank you.
Raghu, I know you gave some details on the HRA credits and what you could potentially generate based on carbon intensity. I know you kind of touched on how that changes as you start selling hydrogen molecules. Could you maybe go in a little more detail, as well as just touch on how long these credits could apply to a unit?
Absolutely. And so the 2 million plus on the HRI is over a 15-year period after deployed. And so if we have a $7 million CapEx and a couple million a year, it's a great ROI from our perspective. What happens is that the moment that we start dispensing, and we hope we are selling right away, the HRI credit drops and another LCFS credit is granted. So the total amount stays approximately the same. And then we get on top of it, when we sell it, there are federal carbon credits that we also get. And obviously the revenue from selling the hydrogen itself. So that's where the revenues can go up significantly. This $2 million amount is one that we hope does not last a long time. We hope it's going to be significantly more, but it's certainly, when we looked at our deployment plan, from my perspective, having been involved in leading edge and bleeding edge technologies my whole career since the 90s, the biggest thing is difficulties predicting the future and timing of deployment of other parts of this ecosystem. This credit's been developed. There's been talk about this credit in other states, and we continue to chat with regulators in other states. We hope it happens. It may or may not, but certainly the states that tend to follow California are the states that are bordering it.
Thanks. And I guess a couple questions. I guess first, you maybe speak on the relationship with the Andretti Group, what that could mean, I guess, as benefits to PowerTap and deploying the fueling systems on existing gas stations there.
Absolutely, and the Andretti Group is not just their network, because they're the Andrettis. They know everyone within the space, so they'll bring a lot of their other partners. Their stations are not branded Andretti; they're branded like Shell and such, 76, a lot of the major consumer brands. Again, with the 100,000 stations and our small footprints, 100,000 existing gas stations and truck stops, there is no need for us to have our own stations. I personally believe in the long and the long medium term, you're going to have stations that have gas for cars, BEV charging stations, and hydrogen at the same locations. What it brings having an existing location is it speeds up zoning a bit. The zoning is still never quick. There's state rules, but you have to deal with the municipalities. We have filed initial applications already a few months ago in Northern California, but some of the basic standards of the land are already met because we're at an existing gas station. If we were going on a fresh plot of land, it would take longer, certainly.
And then, how soon could you really expect to get your first unit on site? And I guess what would be required to get to that point?
And so zoning wise, we expect, I think we said publicly, by the end of 2022, where we hope that process is quicker. But that's what we said. And one of the things I did mention during the presentation, we just announced one of our contract manufacturing partners, Capstone Green Energy, which is on NASDAQ, which is based in California, up the road from us. They have a lot of experience within the green space, and they're very enthusiastic about hydrogen. And so we'll be talk a bit about manufacturing. We'll likely see some geographic focus. Our first units will come out of there, but there's certainly other opportunities. We have significant opportunities in other geographies, including the Middle East, that they're talking about local manufacturing. We'll have to see how that plays out, but we wanted to go with an established manufacturer within the space. They're a $90-100 million revenue company. Large enough to have some experience, small enough that they're excited to deal with us, and so I think that we'd look to have the units ready. It'll be the combination likely of the approval process, and again, the state of California is trying to streamline that process because of this chicken and egg problem right now.
Great. Thanks, Raghu. I think we're about ready here to move on to the next question. So appreciate taking the time to discuss PowerTap and what's been happening there.
Thank you. Just as a last point, anyone can look at powertapfuels.com to get lots of information. And we even have a memo on there on the carbon credit stuff that if any of your listeners want to look at it with detailed math. And I'm Raghu at hydrogenfueling.co. So I'm always available to take questions and calls. Thank you.
Thanks for your time.
Thanks, Raghu.
Thank you. Bye-bye.
So last company presenting today is Cielo Waste Solutions. We have Greg Gagund, CEO, here to present. Cielo, it's a renewable fuels waste solutions company, technology to convert its waste products into renewable fuels, as they've demonstrated at the Alderside pilot facility just south of Calgary. So I'll pass that off here to Greg, give an overview of the company, on recent developments and on the company's plans to further advance its process. So over to you, Greg.
Well, thank you very much. Appreciate the opportunity to present here today. Just want to make sure, do I have control of the screen?
You should now, Greg. If not, I can flip the slides for you.
Okay, I think I do there.
So you can pick whichever company you want to talk about. But
yeah, here, let's start with Cielo. It's a sensitive mouse. I apologize for that. So let's start talking a little bit about the background on the organization, about Cielo. So Cielo is really in the business of taking garbage, essentially landfill waste, and converting it into a usable fuel. One of the advantages when you think of it is, we've got a lot of landfills throughout our nation and throughout the world. One of the things that they're responsible for is the emissions of CO2 and methane. It's really an unfortunate thing, but to be able to take some of that waste and convert it into a usable fuel is something that is quite significant and monumental given the conditions that we find ourselves in as a society. It's going to provide high demand transportation fuel. That is something that unfortunately it'll take at least the next 20 to 40 years before we can wean ourselves off of energy in that regard. Just trying to pass on to the next slide here. Oh boy, apologize.
You should be good there, Greg.
Yeah, you betcha. Thanks. Sorry. The global problem, as I just mentioned, garbage. One of the good things about the type of technology that we use, it's a thermal catalytic depolymerization technology. There is no harmful emissions just by virtue of the type of process that we use. We hope to become one of the fastest growing ESG centric companies in North America and hopefully beyond. And, a little bit of the caption below there, it's spectacular the amount of waste that we as a planet produce. In another 30 more years, we're expecting to generate almost 4 billion tons of waste on an annual basis. So an incredible problem that we have as a planet. Next slide. Here we go. So our solution to this issue, again, I mentioned the type of process that we have. One of the key things about our type of process, currently we use atmospheric pressure and low heat, or very low pressure and low heat. One of the benefits from that is lower cost, obviously, because it's a lot less or cheaper on the input side. The other benefit, of course, is garbage. There's a plentiful amount of it, and typically it's quite cheap. And in fact, in some situations, we anticipate it as being a revenue source also for the overall model. Our process is a significantly quick one to produce biodiesel. And the other thing is we hope to make these things flexible design. I know that we have spoken in the past about having 4,000 liter per hour per day type facilities modularized. That is a concept, but also the ability to ensure that these things are flexible and we can build them for purpose, depending on the site that we're putting them on, is significant. And the other key point, of course, is we do have a patent, an approved patent in Canada and the United States. Some of the key differentiators with our organization with Cielo is, we do have a proven concept, and I'll speak a little bit more about that at our existing facility down at Aldersyde, which is just immediately outside of Calgary. We've got proprietary technology, patents that are issued both in Canada and the United States. Mentioned earlier, it's a sustainable business from the perspective of fossil fuel. We're not using extracted fossil fuels to still fill in this gap as a usable fuel for the transportation industry and others. We have very limited competition in North America. And again, a lot of the cost advantages, multiple revenue streams. So currently, diesel, naphtha are two revenue streams. We also anticipate generating revenue from the waste product that comes from our reactor. And as I mentioned earlier, even on the input side, that could be a revenue stream for us. And of course, in the background, favorable macro in the backdrop relative to where we stand as a society, and the extraction of hydrocarbons is going further and further down the road as not a good end solution. So this fills that transition rather nicely. Just a quick note here on our capitalization, of course. Our financials will be releasing later on this month, mid-month, so these numbers will be updated. Stock price today is dropped a little from where we're at, but the one thing I can tell you too is we do have a capital program or strategy that we're working on to fund the balance of this year, of course, and into next year. So getting into some of the actual facilities that Cielo currently owns and operates. Aldersyde, as I mentioned, is just outside of Calgary here. This facility has been now, I guess it's going on to about 4 years since its inception. Don Ellen, of course, the founder of the organization, has been at it for much longer than that. He, almost 17 years to get it to this point. And where Aldersyde sits right now is we think of it as a demonstration or proof of concept. I can tell you that we can produce diesel. It's been very much an R&D operation up until just recently, where we're transitioning it into a commercialized state. The way that this process works at Aldersyde is we use wood as a feedstock, the biomass. We combine it with used motor oil and a catalyst to produce the distillate that then produces the diesel and naphtha for our sale. We're working right now on a continual optimization of the overall process. I think if anybody has followed this story, we've had a few setbacks here over the last year. There's a lot of really good work that was done. We were operating in a batch mode. We got into a continuous production mode just at the beginning of this year. And by virtue of the amount of production that was starting to become visible and generated from this product, or from the facility rather, we've encountered other issues. There was a lot of blockage, a lot of coking issues that we encountered, and we found some of the weaknesses in the system. The good news is, though, however, we understand what the operating philosophy is. We've really put in more of a robust and beefed up engineering team in-house. We spent a lot of time understanding what the gaps were, and we've done a lot of work on the engineering front, as we currently continue to do. But we've got a solution that we just put out in a press release not that long ago, and I'll get a little bit more into that here as we go into the presentation. These are just a few pictures I thought we put up here. We often talk a lot about Aldersyde, and it's a very real location. As you can see, the top left hand side of the imagery here is a peek inside of our process facility, where we take a lot of the products separated into the various constituents such as naphtha and diesel and water. The bottom left-hand picture is our desulfurization unit that there was a lot of discussion about that this summer and into the fall, that we had just recently commissioned in September. The center picture is an image of our primary reactor, where we take the biodiesel and the UMO and produce a distillate that then becomes diesel and naphtha. And the far right picture is a snapshot of the other secondary reactor, a packed bed reactor that is utilized in our desulfurization unit. So just want to give a bit of a view of what our current facility looks like. So something else, hopefully I can play this video, but just wanted to play this. This is what you're watching here is in real time, the distillate that's being produced from the reactor. You know, I can tell you if we would have seen this just even last summer, it had a much more murkier consistency to it. We were having some plugging issues, and just over the span of the summer, we've done a lot of work to it just to understand what the mechanics are behind why we're getting the plugging issue. But you know, that's real distillate, real diesel that's flowing in that sight glass that I just showed you. So some of the things that we're working on that we actually expressed in our most recent press release as well is the action items and how do we get this to a continuous, a more steady state type of operation. So at the facility itself, we've identified 3 key areas where we're having a lot of the bottlenecks and the issues. One of them is the inlet feed system, which is really how the dry biomass is mixed with the catalyst. There's a whole process in that was not being conducted. We understand how to do that properly now. We also take now the UMO, mix it in properly before we even feed it into the reactor. And temperature is of consequence here, and the type of mixing and control systems at the front end are essentially part of the key on how we get it into the reactor. So that is work that's currently being engaged on right now. The detailed engineering has been completed. We've initiated a lot of the procurement for long lead items, and that's a skid that will be into the construction phase here by the end of this month. The reactor design itself, we found out that there's some issues with it as well. It's not, I mean, it's a reactor that does work, but it's not optimum. And you know, one of the things we were thinking about doing is modifying the reactor itself, changing some of its configuration, the geometry, et cetera. And you know, we found that it's a better solution just to build a brand new one. And it sounds like it's a big deal, but it's really not. It's really a can with some internals that are proprietary. And we're putting the proper inlet and outlet control systems and other devices on the unit itself, which will be part of this construction that we're going to be doing into the first quarter here. And then, of course, the bottom piece, which is the biomass waste management system. As you can maybe appreciate, when you have waste wood, as in the case that we have with this, mixed with the UMO, once it's spent, that product has to be removed and eliminated out of the system. We try to extract all the UMO back out of it, bring it back to the front end. And then we believe that this may be a revenue stream for us with the product that remains. So a lot of the engineering design equipment procurement is in progress right now. And we will be into the construction phase in a heavy way, as I mentioned, by the end of this year. And we hope to have this up and running by Q1, or we will have it into some level of continuous production. Some of the next steps beyond this and in parallel with this, quite frankly, is putting in proper feedback control systems, measurements, metering, all the control systems to improve the production of the Aldersyde facility. We've also purchased some equipment for the front end so we can actually manage the wood as it comes into the facility at a much greater degree. Currently, right now, the wood that's broken down is a little bit larger than the 150 micron level, and we've bought equipment, as I mentioned, that we hope to have engaged here next year. We can grind it down to 150 microns, which will also contribute to the effectiveness of the conversion of the wood into the fuel. And the next steps to this, of course, is we're going to be starting on the engineering feed study for the construction and implementation of fractionation column or fractionation tower, which is pretty standard in industry. And what that's going to get us is essentially the production of kerosene, which we currently cannot produce as it sits right now. Better quality naphtha, better quality diesel. So these are all the processes that we are currently engaging on. This snapshot gives you a little bit of the history and a little bit of the forecast on where we anticipate the production of fuel. So if you look at the left side of this graph here, when you look back into Q4 of last year, you can see that the plant was operating in a very much of a batch mode. And just to describe a little bit what that was like was the guys would run it and would be able to run for about a day or two, and it'd have to be shut down and taken down for at least 2 or 3 days, just by virtue of the fact that we've got 340-degree liquid that needs to be cooled, and that's how long it takes to cool it. And then, of course, start it back up. So you have more of a sawtooth production profile. As a consequence, it's not very effective, obviously. Some of these things were identified at the end of the year, and there was some modifications that were done to the facility at the beginning of this year. So at the beginning of this year, those modifications were invoked. They were activated. COVID hit at the same time, so there's a little bit of downtime there. They turned it on, and it went from a couple of days of runtime to 14 days plus runtime. And that became quite significant from a production standpoint. One of the and you can see by the numbers that there was a lot more production that was generated as a consequence. But one of the issues we found when this was started up is we got into these bottlenecks and plugging issues because it exposed some of the other weaknesses in the downstream elements of the facility that were not contemplated completely. And through the balance of the summer, the company was struggling with trying to get this to run. Since then, we've identified, as I mentioned earlier, what the issues were. We've got a really good understanding of what that is. We've engaged I guess a higher different level of engineering. We've brought in and built in an internal engineering team with some very seasoned individuals. We've got a consulting engineering firm that we have like direct oversight over, and we've also got 2 very experienced PhD level R&D engineers that are with us as well. So a lot of this work has been conducted over the balance of the summer and into the fall. And that's why you see that our production numbers being so low in Q4 and in Q1. As we get into the construction phase and we turn it on at the beginning of Q2, you can see that we've given a range in terms of what the expected outcomes of total production from this facility will be. And we even extended it out into 2023. As you can see, the numbers creep up. And the reason the numbers start to creep up is better knowledge on the maintenance aspects of the facility. We have full comprehension and understanding that some of the quarter turns and half turns we'll be able to do the facility will continuously to improve it over the balance of that time. But at the same time, and in parallel to what's going on at Aldersyde, one of the things that we're very excited about is the Fort Saskatchewan R&D facility that we will be constructing. We just announced not that long ago that we purchased a significant piece of property up in the Fort Saskatchewan area. It's just right off of Highway 15 right in the heartland of Alberta. There's access to rail, there's access to highways. It's a beautiful location. It's 60 acres in size. There's a large 32,000 square foot industrial building on site. And that is going to be the site where we're going to build our first proper pilot, if you will, a 60 liter per hour, a complete system that we can put and house into this building that you see on the screen there. So what this will do for us, it'll be essentially like a scaled down version of what a full scale facility will be. And you get a lot of questions, well, isn't that what you already have at Aldersyde? And the answer is no, it's not. Aldersyde was built under a different pretense. It was like a very large coarse R&D facility that we can get up to a commercialized scale here in short order. But what this scaled down version of this facility will do is we're going to put like full on avionics on board. So we'll be able to measure things like density measurement, temperature profiles, pressure profiles, have a full understanding of what the proper material balance, energy balance, thermodynamics, flow mechanics. These are the things that you need from a scientific perspective, from an engineering perspective, to be able to start determining what a full-scale facility will look like, and more importantly, what the economics that surround it start to translate into. And it'll give us the opportunity beyond this to really start experimenting with and understanding different types of catalyst combinations, which is this could be an ongoing activity for us to continuously improve that product. But also play around a little bit with pressures, just increasing pressure slightly. We currently operate at atmospheric. We don't have to go to crazy temperatures and get into the thousands of pounds of pressure, but small amplifications of pressures may be meaningful to get a better reaction. And the other thing it'll allow us to do is experiment with different infeeds. We have done, this company has explored with multiple infeeds in the past on a very coarse basis. There's some very positive outcomes that come of it. But with this, we'll be able to get at a very detailed infraction and understanding how plastics behave, how railroad ties behave, how organics behave, that sort of thing, and build a model around that. And with this, I mean, this will be really what we call the a center of excellence. I mean, I see this as being an area where we train our operators for the operational philosophies that we will introduce on how we run these operations when they're at larger scale. It'll be an area where we continuously do research on catalysts. We do research on the next turn, getting away from the utilization of UMO and getting into different spaces on the research front. So, and plus, we'll have the ability to probably put approximately anywhere from 2 to 3 full-scale facilities, anywhere from 2,000 to 4,000 liters per hour. So it's a pretty big site for this organization. This slide really, I just want to highlight just the magnitude of the facility that we're building. The bottom right-hand photo is one of the bays that are offered to us in this facility. There's 2 of them, like they're massive. They're 10,000 square feet a pop. They got 45-foot ceilings, and our intention is by Q1 we'll be into the heavy throes of the construction of a skidded pilot, which you see in this diagram. Is a little bit of an image to show you that there is some work going on. We've got a lot of very detailed engineering drawings that we've already gone down the path to concluding, and we're actually into the throes of procurement as well. So this thing's going to be built in one of these bays, and the other bay we're going to use for the fabrication for not just the pilot, for any future type of activities as we start to grow this. The top right image gives you a little bit of the size and scale of the facility, or the plot size. It's massive. It's 60 acres. As you can see, there's ample place for this organization to build some full-scale facilities. And we'll have the R&D and all the lab type work housed in that building. And the other thing it does have is approximately 12,000 square feet of office space. So it's a perfect layout for us to really formulate the ground for the what this company brings to the future. The R&D facility plans in progress. This is really a much more detailed analysis on or view, pardon me, of where this project is. As I mentioned earlier, we're well into the engineering phase. We've started and we just completed the detailed engineering. We've started some of the construction already. So just getting the building prepped for the adherence of the pilot itself is something that we've already started. The electrical systems, HVAC systems, so on and so forth, that's already well underway. We're starting some of the equipment fabrication on site in early January. And then we'll start with the structural fabrication for the skid itself in February. So by Q1, we'll be in kind of full-blown putting this whole thing together, essentially. And we're anticipating that we'll have this up and running by August. And once August comes around and we run the type of experimentation and testing that we need, we will be in a situation where we can now start looking at proper EPCM companies for the construction of a full-size facility at that site. And in parallel to that, we also want to get into the analysis of plastics. We need to get through the wood elements first, so we can build this facility, which is what we've got the most experience and background in. But we really want to get into a material position with the understanding of processing plastics well into this year. And again, this is a bit of a snapshot of the milestones and a little bit of a cartoon on how we see this thing evolving. So is it a proven technology? It is. Like we've played around, as I mentioned earlier, with multiple feedstocks in the past at course levels. The most amount of understanding we have right now is on the wood side, and it's waste wood. It's wood that is coming from some of the lumber mills. It's wood that's going to be coming from fabrication facilities that use waste as a waste product. That's the type of materials we've been using. We've identified so far right now that we can produce low carbon intensity naphtha and diesel, and we will be able to produce kerosene with the next turns of this. So the proof of concept on the alder side of it is complete, and we'll continue to refine that. The cartoon on the right hand that you see there, if you can see the Aldersyde demonstration facility and you parallel it with the work that we're going to be doing at the Fort Saskatchewan R&D facility, the more fine tuning, that's how we're going to get into the first gen, or call it Gen 1 waste to fuel facility. What we learned from that one, plus the continual efforts that we do in the R&D facility, we'll get into Generation 2 facilities. Perhaps at this point, we're talking about the addition of plastics, and then so on and so forth. It carries on to the next generation where, there's another, whether it's railroad ties or whether it's organics or it's a combination of all. I mean, these are the things that we're going to continue to explore. And these are the things that we're going to hopefully be in a position that we can construct at full scale. And then, so this again, just kind of getting to the summary of how this all comes together. There's been on the organizational side, we've got a very strong, committed management team. There is Stephanie Lee, our CFO, Chris Sabat, our Chief Legal Officer and Corporate Secretary, myself, CEO and COO, and we've built up like a very good, well-dedicated group of individuals from a technical perspective. Corey Sidebottom is our lead engineering manager for the organization. He drives all of the technical aspects of the organization going forward. We've also brought in a very seasoned plant superintendent that's brought another level of leadership to the organization, Ryan Carruthers. He's building things that you start to build as you construct these type of facilities, like PM programs, maintenance schedules, understanding the operating costs for the type of operations that we run, ensuring we have consistencies and KPIs that we can measure and hold ourselves accountable. These are and just getting into that operational excellence sphere is a lot of the key drivers that we're going to continue to push down through that. We're working on a capital strategy to fund ourselves through 2022. That's in progress right now. And of course, with the Aldersyde facility, that is kind of the pivotal piece for us, where we've got an actual working facility that by the end of this year we will be in, or pardon me, the end of next year we'll be in a whole different sphere. We'll be in a continual production environment. We're starting to get into more of the shred credits to take advantage of that. A lot of the chemical issues and mechanical issues, we've identified what those are, and we've got a plan to correct it, as I just mentioned. And the Fort Saskatchewan, of course, that is our long-term projection on this. That is going to give us the right balance in terms of understanding all the metrics that go into the construction of full-scale facility. And it creates a center of excellence for us from both an operational perspective and also from any future new developments on full-scale facilities. These are just just a reiteration of what I've just discussed, but really it's the expansion of the existing Aldersyde facility. The second facility that's going to be 100% owned and operated by Seattle will be at that Fort Saskatchewan location. When I think about potentially the third and fourth, they could also be at the Fort Saskatchewan location with different infeeds, and we continue to explore other areas where we can actually introduce this technology at key locations, whether it's a landfill site, but more importantly, it's at some of the facilities around our globe. Any kind of manufacturing facility typically has a lot of waste products. That is a problem for them, and to be able to build and construct something in cooperation with some of these places, we can purposely design them to sit to suit the site and the type of production that would be generated from the in-feed product. So with that, I can conclude the presentation. I'd be happy to take any questions.
Thanks, Greg. Mike here. You'd highlighted the recent guidance or outlook for fuel production at Aldersyde. Just curious, like how you would expect to sell these volumes. Like, would you look to sell them through Elbow River marketing, or would you look to sign some sort of offtake agreement? And what sort of sales prices would you also expect from this?
Yeah, so it's a good question. So it can be anybody right now, to be quite frank. One of the things that we don't have in house that we're looking at bringing in is actually a commodities expert. To me, there's spot market pricing. It changes day to day. Obviously, and taking advantage of that is one of the key things. We've got an agreement already with somebody for the offtake, but there's other end users as well. We talked about fuel, but there's also the opportunity to use some of the product that we produce as a diluent for the oil and gas industry, for moving heavy oil through pipeline systems, etc. In terms of pricing, I guess that range is quite high. Until we get into a situation here where we can actually clean the product up to the point where it meets a lot of the roadworthiness elements of it, we start competing with diesel that you can buy at the pump. Essentially, the product that we have right now, it'll probably fetch anywhere from 50 cents to $1. Essentially, we'll get into the next turns of refining that product, and it'll scale up from there. Today, we start getting into what's considered to be a proper biodiesel product, which you have to meet a certain CI index score. Then that'll fetch even a higher value as well. But some of the key things also when you think of pricing, as I mentioned earlier, the waste stream could become a potential revenue source for us as well. And even the feedstock itself could be another potential element. And the thing we haven't even explored yet is the carbon credit elements of it as well. So there's a lot of interesting, I think, elements that feed into the whole economic component of this.
Hey, Greg, it's Clark here again. Thanks for the fulsome update. You've gotten us back up to speed for those that wanted to get caught up, and I think you did a great intro for some of the new faces. You're our last presentation of the day. So thanks for your time, Greg. And we're just going to wrap up here now. So to everyone else that's still here on the line, thanks for making the time. For the investors that were able to tune in for some of the stories, and for the management teams, of course, for being able to present and to get their story more broadly understood out in the public space. And on behalf of Echelon Capital Markets, thank you to everyone who was able to tune in and make today more impactful by having more eyeballs on some of these stories. And thank you and have a great week.